Good evening. So today the topics are a little lengthy. So if at all poverty, unemployment, inequality is left, we'll shift it to the last class. So last class the topics are like we have only infrastructure. So there we can push it. We'll try our level best. But there are some additional details which I want to give you other than what is there in the slide. So for that, it may take some time. And if we miss one topic, we'll put it to the last class. That's what we'll do. Okay. Okay, so this is the first area that is related to the external sector. Okay, so here, so BOP is nothing but an accounting statement which records economic transactions of the resident of India with rest of the world. Okay, so accounting statement which records economic transactions of resident of India with rest of the world, right? So these economic transactions include several things which we can classify them into two different accounts. One is the current. So this is the old classification, which we all know. RBI is following this classification. Generally, the data is released like that. But there is also one more data, which is called as the BPM6 data. Okay, so we'll also try to understand that. So this is current account and capital, current and capital. And you should also remember that BOP is a double entry system. That means for every credit, there would be debit. And that is the reason always BOP is zero. Theoretically, BOP will be zero because for every credit, there would be debit. Suppose you're buying some goods, you have to give money. Something moves in, something moves out. Is that okay? So it's a double entry system, and that is the reason. So how double entry accounting is done, it's not required for you. But since it's a double entry system, your BOP will be zero. Okay, so here, when I talk about current account, what are the entities that are part of the current account? So one is merchandise trade. We talk about goods. Okay, then services, income, and transfers. So our remittances are also in this transfer segment, right? Remittances will also be part of the transfers, right? In the capital account, basically we have what? We have one, we talk about investments, and two, borrowings. So in the material, they have written foreign aid, but foreign aid, if it is in the form of grant, then only it will be in the current account. But foreign aid is in the form of loan. So foreign aid can be in the form of grant or it can be external assistance. Assistance is something like a soft loan. So only if it is a soft loan, it should be here. I think you got my point, right? So in the material, it's like foreign aid. So foreign aid in the form of grant or a transfer should be here, isn't it? And if it is in the form of loan, external assistance, then it should be in the capital part. So that should be clear. And here, when we talk about investments, we know that there is FDI, we have portfolio investments. Okay, and then we have, so ADR and GDRs are there. I'll come to this in the subsequent discussion. American Depository Receipts and Global Depository Receipts. So according to RBI pushes them as part of FPI. But according to government, FEMA rules, FEMA believes that so whenever government is giving its FDI data, in its FDI data, government also puts GDRs. But RBI, when it is releasing its data, RBI will include these receipts in the portfolio investments. Is that okay? Fine. So then in the borrowing, we have external commercial borrowing, long-term borrowing, generally 3 years. Okay, so long-term borrowing generally taken by corporates for a period of 3 years and above, right? And then you have external assistance. External assistance. This is, we call it as what loan? Soft loan. Okay, and we also have NRI deposits. NRI deposits. Okay. NRI deposits. Now, what you should understand is there is something like rupee debt service. Okay, so which can come up in the exam because it is there in other exams. So I've written here rupee debt service. I've written rupee debt service. So rupee debt service, if you look at the RBI's data which is released, you will find that the rupee debt service is also part of my capital account, first thing. Okay, so this is an additional info which you'll keep in mind. So rupee debt service is part of my capital account, capital. The word debt itself will tell you like, okay, it should be part of capital. There should not be any confusion because in the capital account you have what? Borrowings and investments. Okay, so rupee debt service is part of capital account. But the only observation is when I say what is debt servicing? Debt servicing is something like both the principal as well as interest. Both the things would be figured out in the capital account. On a general note, interest should be part of my current and principal amount of the loan will be part of capital. Getting this right? Loan principal amount will be loans, investments and borrowings. Don't get confused here. Suppose tomorrow you find an option like rupee debt service. So rupee debt service should be part of my capital account. Are you able to get this? Not in the current. So what is the meaning of rupee debt service? You are servicing the debt. You are servicing the debt. How are you servicing the debt? You are paying in the form of principal and interest. Okay, so principal as well as interest. So rupee debt service, one simple observation here, rupee debt service includes both principal payment on the loans taken in rupees as well as interest payments. The loans you have taken from foreigners in rupees basically. Okay, in rupees. You can take loans from foreigners in rupees as well. And this rupee debt service, which includes principal as well as interest payment, will be part of my capital account. Is that okay? Okay, so that is one observation which you will keep in mind here, which generally is not visible in the regular notes. And there is a chance UPSC can ask. So here, rupee debt service, principal and interest repayments. So debts to be paid in rupees to foreigners by Indian residents. Debts to be paid in rupees to foreigners by Indian resident. So that means I am paying back the loan, the principal amount, as well as the interest in rupees. Is that okay? Is this clear? Understood? Okay, so why is it important is because it is in news. It is in news. We borrow maximum in dollars. Okay, so around 54% we borrow in dollars, followed by rupees. And that is the reason that rupee debt service has come up in news. And if this rupee debt service comes up, where should it be figured out? It should be in the capital account. Is that okay? This is from the government data only. Okay, so now when we talk about rupee debt service, so there is this news which says external debt service ratio of India is around 5.3% only. Okay, and that is something like a very positive aspect. That means external debt, that means government is borrowing from outside. We are borrowing from outside. That is what is external debt. So you're servicing that debt. So how do you service that debt? So debt service means you're paying principal plus interest. And you're also receiving some receipts. Maybe that receipts can be in the form of remittances, etc. So this is your, so extra, that means how much receipts you are getting to service your debt. How much receipts you are getting from outside India to service your debt. That is what is external debt service ratio. The news is like external debt service ratio is 5.3%, around 5.2, 5.3, which is a very low level. It is good, in fact. That means, Madam Nirmala Sitharaman Madam was saying, you're saying that we are borrowing, but our external debt service ratio is 5.3, which is pretty decent. Okay, so that means we are able to service our debt easily. Is that okay? I have to increase the speed. Oh, okay, so rapid. Because this is something you're writing it down, that's the reason I'm going a little slow. I think it is clear, understood, right? So this you keep in mind. Now, out of all, there was this question, all our external debt is in dollar. Previous question, wrong statement. Around 54-55% is in dollar. Okay, then followed by Indian rupee denominated debt. That is rupee debt service, which I was talking about. This is what is Indian rupee denominated debt, around 30%. Okay, so Indian rupee denominated debt means how are we borrowing in rupees from outside is the question. How are we borrowing in rupees? FIs who are coming into India, they may buy treasury bills, etc. Okay, or NRIs, there are 3 types of NRI accounts. FCNR is there, NRE is there, NRO is there. Okay, so FCNR is maintained in dollars. But when we talk about NRE and NRO accounts, there are some NRI accounts which are maintained in rupees. That means NRI deposit means it is kind of debt only. NRIs are giving you debt. Is that okay? NRIs are giving you debt, right? They're putting money in the bank. They're giving you debt. Okay. And then masala bonds. IFC was the first entity to issue masala bonds. First entity to issue masala bonds. So the masala bonds are what? Rupee denominated bonds issued in other countries. IFC issued, which is a World Bank wing. It has issued masala bonds to raise money for the first time in 2014 for infrastructure projects. Similarly, if you are seeing the same rupee denominated, or foreign institution, IFC was issuing rupee denominated bonds in India, then that is Maharaja bond. Maharaja bond is like rupee denominated bond issued in India to raise money in rupees. You should have been reading it in the newspaper. So IFC did it. That is a foreign institution issuing rupee denominated bond in India, Maharaja. Rupee denominated bond issued in other country, masala bond. That means you're borrowing from outside India in rupees. Is that okay? So you'll at least remember this, the US and then, okay, this, I think it is clear. It's no confusion there. No confusion, right? Okay, so, and going deeper, we can't dig deeper because this is rapid revision, we don't have time. But what can come in the exam? One is this, see, BOP and International Investment Position Manual. This is mentioned in the material, but how is it classified is not mentioned. Okay, so this is a new methodology of BOP division, which is there. So now IMF also has come up with a new method of BOP division. Old it is followed as well as new. Okay, so it's not that you have removed the old one. So in the new method, you have 3 classifications: current, capital, financial account. You have current, capital, financial. Otherwise, what is the BOP classification? Current account and capital account. But here in the BPM 6, you have current, capital and financial. 3 will be there. So that is one thing which you'll remember. And second important observation here, in the current account, you have goods and services. It remains the same. Goods and services, goods trade. Okay, so goods and services. So goods, that is basically merchandise trade, services trade, etc. And then it says primary income and secondary income. This is how the classification is done. See, primary income means income which you are getting because of rendering factors of production. Factors of production. That is, you worked or you're generated some profit because of business. You have given your house on rent. You're getting rent. You're generating money because of factors of production. So that is primary income. If it is transfers, it is secondary income. Remittance, transfer, grant. Is that okay? So it's the same, but this is how the classification is done. Okay? Yes, primary, secondary. And then in the capital account and financial account are separated. Otherwise, both were part of the capital account. So in the financial account, you have investments, FDIs, FPIs, you have foreign derivatives, and you have loans and reserve assets. Loans, all that ECB and all that. Okay, so loans, okay, investments, all that is part of the financial account. Is that okay? And in the capital account, you have gross acquisitions and capital transfers. Gross acquisition and capital transfer. This is what is written there. Okay, so gross acquisition and capital transfer. Specifically, he may not ask, but he may say the BPM 6 classifies BOP into 3 different categories. That statement will be right. That much you should be able to identify. Exactly if I don't know also. Is that okay? So here, capital acquisition, capital transfers. Financial account has that investments and loans. And here in the capital acquisition and capital transfer, so that is something like capital transactions in non-financial and non-produced assets. Suppose you are selling a loan, so you're selling a land. Land is not produced by you. Sale of land is an asset, no? Okay, so all these kind of transactions, you sold your patent or land, all these things will figure out in this capital account. Are you able to get this? Land, non-produced asset. You did not produce the land, right? And you're selling it off. Okay, so that is basically, and capital transfers will include something like acquisition and disposal of fixed assets. And suppose India has removed some debt for somebody. India has given loan to Afghanistan. It said, you need not pay. Debt forgiven. So these kind of things are also there here, capital transfers. So I don't think specifically we'll ask capital transfer, but you should know capital transfer is there, gross acquisitions are there. And you're talking about assets like non-produced assets, which are you're selling or patents, etc. All these are in the capital. And then FDI, FI, all this will come in the financial. Just because you've learned this, the regular BOP you should not forget. Okay, so that you keep in mind. Okay, I hope it is clear, right? So now you need to be fast. So this is all our UPSC easy previous questions here. So here, in terms of economy, visit by a foreign national to witness some Commonwealth Games in India, 2011. Export, you know this already, we've talked about this. Consider the following actions which government can take. Which of the above actions can help in reducing the current account deficit? Okay, now see here. You know this, when we talk about the current account and capital account, okay? So current account, after all these transactions, if there can be surplus, or there can be balance, or there can be deficit. Okay, so the most important component of the current account is my trade balance. Trade balance. Okay, so you can have a surplus trade, or you can have deficit trade, trade deficit, or we use a word balanced trade. Balanced trade generally you will not find export is equal to import. Okay, surplus and deficit. Deficit is what? Import is greater than export. So that you know. And mainly the deficit in this account is because of my trade deficit. Okay, so that is a very common thing which you should be knowing. Okay, and if whenever there is a deficit here, we generally have a current account deficit. News says 2022-23, in one of the quarters, current account deficit was only 1% of GDP. Okay, suppose he's asking a trend-based question that current account deficit was continuously increasing, it is wrong. It shows that 1% of GDP pretty decent. Is that okay? Up to 2 also it's okay, right? Okay, so the current account deficit, but we face generally current account deficits. We face current account deficit. But last 10-15 years, always there was deficit? No. There were periods where there was surplus during COVID, etc. But current account deficit, we try to bridge it from the capital. Okay, so generally we have capital account surplus. More investments are moving in. So we have capital account surplus. Okay, and if this is also not sufficient, then if suppose this is minus $100 and here you have minus 500, sorry, plus 500. Okay, then you push this into bridging the current account, and whatever is left will be going into RBI in the form of my Forex. So this is called as net addition to Forex. Net addition to Forex. Net addition to Forex will be a debit in my BOP account. Is that okay? Net addition to Forex. I am removing money from my BOP account. Okay? Is that okay? Yes. So, but if there is, if suppose this is also negative, then what will we do? You have to remove money from the Forex and push. Okay, and if RBI does not have reserve, we had a crisis already. And we say RBI, the BOP crisis mainly because we did not have Forex reserve. Is that okay? That is the reason, because RBI also did not have. So since RBI did not have money, now RBI had to take it from banks like IMF, etc. So that is basically called as below the line transactions. So in BOP, you have above the line, below the line transactions. Above the line transactions are all those transactions which are happening because of a profit motive. There's some intention. Okay, below the line transaction is something like since it is not balanced, you're bringing money from somewhere, RBI or IMF, etc. So these are called as below the line transactions. Above the line, below the line transactions. Is that okay? Yes. And current account deficit and fiscal deficit are called as twin deficits. This is what is twin deficit hypothesis. One leads to another. This is called as twin deficit hypothesis. Okay. There should not be any. This is something which you already know. It's not like the BPM. Okay. So now here, sorry. Now this was a previous UPSC question only. So what should be done to reduce the current account deficit? Okay, you'll tell me after the break. Okay, so think and tell me after the break. Previous UPSC, you can't say it is difficult. See, reduction in export subsidy should be there or removed? Huh? See, you have to reduce current account deficit, means you have to increase export. If you have to increase export, means you should give more export subsidy. If you reduce export subsidy, then there is a trouble. Is that okay? Okay, so that means if I remove 2, okay, so then it should be C or D. Is that okay? Yes. Is that okay? Understood. So now, see here, FDI and FII are related to investment in a country. Which of one of the following statements best represents an important difference between the two? Okay, so this was a previous type question. We see how FII, FDI questions evolved over a period of time. So this is a basic definition of FDI. So what is the basic definition? Foreign investment that is moving into a country with the intention of doing business. Okay, or it is directly having control over the assets in the country. That is what is FDI. It brings in technology. It brings in employment opportunities also. Okay, so that is a basic definition of FDI. Okay, so FII investments are indirect investments. And here the intention is not to do business. And FII investments can go into debt markets or it can go into equity markets anywhere. Okay, so FIIs are less stable. FDIs are more stable. Is that okay? FDI is more stable, FII is less stable. But the new definition, of course, we are talking about control in a company. Suppose if the portfolio investment into a single entity is crossing 10%, then you will be treating it as FDI. And once it is treated as FDI, henceforth it will be treated as FDI. This is the new definition of FDI. So recent question is based on the new definition. This is an old question. Is that okay? Yes. So both you should know. So here if I see, FIs help bring better management skills and technology. No, FI helps in increasing capital availability in general, but FDI only targets specific sectors. FDI flows only into secondary market, while FI targets primary market. Wrong statement. Secondary, primary. FI is considered to be more stable, useless option. Okay, so FI helps in increasing capital availability in general, while FDI only targets. Is that okay? So you should not get confused. This is about the BPM 6. Okay, so this is BPM 6, but you should know what is there in the BPM 6. Okay, now India's case, our BOP is currently positive. And it is positive because of the capital account. Though current account there is deficit, our capital account we have positive. So tomorrow is there a chance for having a similar kind of BOP crisis which we had in 1991? No. Why? Because we are sitting on forex reserve. So there is no problem. Okay. So when I say $620 billion, $630 billion, there is no problem, right? Okay. So when we use the word forex reserve here, so forex reserve is under the control of RBI, and forex reserve mainly has 4 main components. One is the foreign currency asset, major component, and then we have gold, and then we have SDRs, and we have the reserve Tranky positions, RTP position in IMF. So there are 4 components. Okay, so this is the major component. So based on this, there was a question in CDS this year, but there was a very tricky question. I can say, I'll tell my answer. Let's see what UPSC gives. Okay, so this is about foreign currency asset, gold, SDR, and RTP in that order. Okay, I'll come to RTP and SDR after some time, right? So here, if you see, BOP is a systematic record of fast. A. Though you may feel it is only like trade only, but other options are hopeless. Capital movements from one country, partial. Economic transactions between government, no. Resident includes government, individual, private entity. Goods exported from a country, that is not, that's about, it is nothing but export. All import and export transactions of a country, import transactions, I missed it something, huh? Import and export transactions of a country during a given period, normally a year. I was typing it in the car, so is that okay? Yes. Now, which one of the following groups of items is included in India's forex reserve? Previous question, 2013. Just because RTP is not there, you will not mark something else. That is what you have to learn from that question. Is that okay? Understood? So less we think, we'll mark better. Okay, so I think this option, okay, right. Clear? Okay, so this was asked in 2024 CDS. Okay, so one is, I go with one. There is no cost of holding foreign currency as reserves by a nation. Everything has a cost, that is what I believe. If not a regular cost, opportunity cost. There will be cost in terms of valuations. So tomorrow if I purchase dollars, assets, etc., so if the value of that is going to fall, then I may incur a loss. If the valuations increase, so we also tally valuations, okay, in the balance sheets of RBI. So it can be positive or negative. So there is some cost always that is there, but that's how I take it. But how RBI, how UPSC takes it, let's see. Is that clear? So this is how the questioning pattern was. Okay, so current account balance. Okay, so here you know what is the current account balance now. And in the current account, you have the visible as well as invisible. No confusion there. Visible is the merchandise that is trade. Invisible is the other aspects which you have in the current account. So that is simple. Okay, and way to deal with current account deficit. So there were previous UPSC questions. How do you deal with current account deficit? One question we have seen. Okay, increasing exports, putting restrictions on imports. Is that okay? Putting restrictions on imports. Okay, so, and allowing more foreign investments into India, though it will go part of the capital account, etc. Okay, so that is. So till here, I think we'll dig deeper now. So when we talk about different investments, one is we have FDI, and then we have portfolio investments, okay? That is foreign portfolio investment. In the foreign portfolio investment, you have FII. Okay, you can classify that also. You have QFIs. QFIs, qualified foreign investor. Okay, and you can have sub-account holders. So if I dig deeper, the foreign investments can be classified into direct investment and indirect investment. Okay, so here we've written FDI and FPI. So two things here. One thing is something like the old definition which you already know, and now it is based on the control of the asset. Okay, so control of the asset is basically with respect to portfolio investment into a single entity which is greater than equal to 10% will be treated as FDI. Once you treat an investment, such investment as FDI, it will be treated as FDI only. Okay, now two things here. Portfolio investments are regulated by SEBI, right. Okay. Portfolio investments can go into equity, that is, it can get into the share market. Even it can also get into the debt market, bonds. That means they can put their money into these entities, or they can also put the money into shares. Okay. Portfolio investments can be into primary markets also at times, as well as secondary market, primary market. Okay. So directly they are investing into a company. Okay. So for example, yesterday we've seen something like angel tax or angel investors. Okay. So currently angel tax is also pushed on the foreign investors. This is a news. Okay, so when we talk about startups are funded by venture capitalists or angel investors, VCs or angel investors. Okay, so this is anyhow there in our discussion today. Okay, so venture capitalists and angel investors, they generally ask for equity only. Generally, they can also give loans, but generally equity. What do? Fund risky startups. But out of these two, angel investors generally give seed capital. Seed capital is initial capital. Initial capital when I've started the business. But why was it in news is angel tax, which the madam has pushed the angel tax on the foreign investors as well. So that means there can be a company X in which the startup money is coming. Okay, so let's say this is a startup. Okay, so there is somebody, an angel investor, who has pushed money into your startup. Okay, so your valuation, you put it as 1,000 crore, company's valuation. So this angel investor has put in 500 crore into your company, and he has taken 50% stake in the company. 50% stake in the company. Okay, now the officer comes up and officer conducts the fair market valuation of the company. Fair market valuation of this company, and he says it is only 500 crore. You put it as 1,000, but the fair market value of this company is only 500 crore. So 500 crore means for 50%, he should have pushed how much for 50% stake? He should have pushed only 250 crore. That means how much extra over the fair market value? 250 crore extra over the fair market value. On this 250 crore, there is an angel tax that would be levied. On this 250 crore, which is above the fair market value, there will be angel tax that would be levied. This is what is angel tax. Is that okay? Okay, so this is angel tax. Angel tax has been shifted on even the foreign. That is the reason angel is in news. Therefore, you should be ready for angel investment, angel tax, who is this angel fellow, etc., etc. That's it. Okay, so that means foreign institutional investors can also invest in the primary market, or they can also invest in the secondary market. So primary, secondary market we will discuss in the capital market today. Okay, so till here I think there is no confusion, right? And when we talk about FDI, foreign direct investment, so FDI can also classified into different entities here. You can see here. So direct investment, indirect investment, one wholly owned subsidiary. Okay, so investment in the business by a foreign citizen usually involving majority stock ownership of the enterprise, wholly owned subsidiaries. Okay, or joint ventures between the foreign and the domestic company. And so in the foreign investment, FDI is there, portfolio is there. So FDI investment can move through automatic route or government route. So earlier there used to be a board called FIPB, Foreign Investment Promotion Board. And that Foreign Investment Promotion Board under the Finance Ministry used to do case-by-case approvals for FDIs that are moving through the government route. But FIPB has been scrapped. You don't have FIPB board currently. So FDI that comes in can come up through automatic route or non-automatic or government route. Today, government has taken up decisions in terms of liberalizing norms with respect to foreign investments, right? So that is the reason most of the chunk of the FDI that is coming in is coming through the automatic route. Of course, not all, but major chunk is coming through the automatic route. Okay, so when we talk about different forms of FDI, if the FDI money is coming in, foreign investment is coming in into a project where you are starting the project from the beginning, from the scratch, you call it as greenfield. Brownfield is already existing company. So you're putting in money, that is brownfield. I don't think UPSC will ask this. Okay, so because most of us know. So greenfield and brownfield, okay? Then foreign direct investments can be categorized into horizontal, vertical, and conglomerate. So this is something little new. So horizontal, vertical. So when I say horizontal FDI, a company establishes the same type of business operation in a foreign country, which it is operating in the home country. The same type of business it is putting in the foreign country, which it is operating in its home countries. That is called as something like horizontal. So that means a cell phone provider buying a chain of phone stores in China is an example. Is expanding in the same area. Is that okay? Then here, vertical is something like he acquires a complementary business in another country. Okay, so that means you are building your supply chain. So you want a raw material supplier to your company, etc. Okay, so that is called as vertical integration. So horizontal, vertical. Vertical is something like you are coming up with a foreign company that supplies it with raw materials it needs. You're buying a company which can supply raw materials for your manufacturing of the same cell phone, let's say. Is that okay? So that is vertical. Then in a conglomerate FDI, company invests in a foreign business that is unrelated to its core business. Completely new business. Completely new. You're a mobile phone, you're starting a bank. Got the point, right? Okay, so, and because the investing company has no prior experience, area of expertise, this often takes in the form of a joint venture. Here they will go for a joint venture because they don't know how they function, simply. So is that okay? So conglomerate, you remember? Okay, so, and it ends up as a joint venture, and then vertical and horizontal. The words, that's it. So portfolio investment is risky. So it goes into both equity, debt, and all that, which we already know. So there's no confusion there. And generally, portfolio investment is seen as short-term. So I can classify the portfolio investment as one FIIs, foreign institutional investments, right? And you also have qualified foreign investment, not in use much now. Qualified foreign investment. Okay, so they are also part. Okay, there are some sub-account holders which operate under the FI. See, institutional investors put lot of money in the markets. If we can follow them, we will become rich, simple. Because they have a lot of research mechanism, they will do all the research, they will put money in the stock market, we keep a track of them, and we will be closely following them. I'll be generally closely following these fellows because these are institutional investors. They put in crores of rupees. A share price will increase because these fellows are investing. Whether it can be domestic institutional investor like the mutual fund, or it can be foreign institutional investors like the FIs. Okay, but what is the benefit for us? Indian company is able to raise capital easily. That is the benefit of FI. Okay, so capital is easily available because of FI. But FIs are volatile. There can be flight of capital. Easy flight of capital because restrictions are less. Is that okay? Now, after 2011-12, there was a situation where our rupee value was depreciating. Rupee value was going down. Rupee value was depreciating. To handle this problem, we wanted to depend on FDIs and FIs. But FI, every Tom, Dick, and Harry cannot become an FI investor. There are conditions. Okay, so institutional investment, which it moves in, there are conditions. So therefore, that is when the QFI concept came in. So the meaning of qualified foreign investor is something like the way Indian invests in the Indian stock market. How do we invest in the Indian markets? We need something like a DMAT account. For opening a DMAT account, you need something like your PAN card. Similarly, a foreign entity will also open a DMAT account and they will be able to directly invest into Indian stock market as an Indian does. That is called as QFI, Qualified Foreign Investment. Is that okay? But this is also portfolio investment. You can't put it as FDI. Is that okay? It is not FDI. Is that okay? And QFI, the only condition is this investment should be coming from that country which is a signatory to FATF. FATF is Financial Action Task Force. In your internal security class, you would have come across this FATF. It's an organization entity which handles black money, laundered money, etc. So that country should be signatory to FATF if QFI has to move from that country. Suppose Pakistan has lost QFI status, that is FATF status. That means these QFI investments should not be coming from Pakistan. That is the meaning. Is that okay? So here you can see sector specific, general capital market. Okay, so or into a company. Long term, FDIs are generally long term and portfolio investments are short term. Okay, now see here. This was easy question. Earlier, like I think 2017 or so. 17, 18, up to 2012. So it will be even more easy. Now UPSC changed. So which one you have to remove? FDI, first you have to remove 4. Finished. That's how it is. Okay, you remove 4, then you have majority foreign equity holding in Indian companies. Now, this is something like, currently if I look at this option, there can be some trouble because now you have a new definition that is there. Okay, so is that okay? Clear till there? Okay, so you eliminate 4, you get to the answer here. Answer should be 1 and 3. Subsidiaries of companies in India. It can be wholly owned subsidiary. Okay, and then companies exclusively financed by foreign companies. Exclusively. That means they'll have a higher shareholding, etc. And majority foreign equity holding in Indian companies. Now this basically, now if you look at this option, it because above 10%. But that time that discussion is not there much. Are you able to get this? Okay. So this is how it has evolved. So this is the new question before last year. Okay, so till here I think it is okay. Only for BPM we have taken more time, that's it. So this is, you can see evolution in the UPSC questioning. So here if you see foreign FII with certain conditions, that means FII with certain conditions is FDI. This was picked up, he copied this question from the government FEMA rules. Okay, the document is picked. There you will find the FDIs will include, it will include FCCB, comma, FII with certain conditions, comma, GDRs. This is how it is written. So he picked that question from there. He added one more word called NRE and he has given the question. Is that okay till there? Okay, so here, 2 things here for understanding. FCCB, foreign currency convertible bonds, FCCB, foreign currency convertible bonds. Now these are issued by Indian companies to foreign entities. Indian companies to foreign entities for a long-term period. Long-term means you're raising money for a long-term period. Is that okay? So that means this FCCB can be figured out in my ECB also. Bond. Okay, but foreign currency convertible bonds. So convertible bonds are those bonds which can be converted into equity after a certain period of time. So that either in full you can convert or certain portion you can convert. So that portion which can be converted into equity, that is something which can be converted later into equity, will be part of my FDI. So the question here is, which of the above can be included? It is not definitely included. Can be. It can be included. So that portion of FCCB which can be converted into equity can be included in what? FDI. Are you able to get this? But that portion which cannot be converted into equity, which remains as a debt only, I have to hold it as a bond and redeem it after the maturity, that will be as ECB only. Is that okay? So FCCB may figure out even in my ECB that, but which portion? That portion which cannot be converted into equity, which remains as bond only. I'll redeem it after the maturity period. That portion will be in ECB, but that which can be converted into equity will be in FDI. Is that okay? Then FI with 10% condition, yes, but this is not, NRI deposits generally are debt. Remember we talked about debt. So there in the debt you will find NRI deposits. It is NRE, non-resident external. You have NRE, NRO and FCNR. FCNR account is maintained by NRIs only in foreign currency. That money is maintained in only in foreign currency. And FCNR account is maintained only in term deposits. term. See, there are FCNRB, foreign currency non-resident Indian bank account. Okay, then you have NRE account, and you have NRO, non-resident ordinary, non-resident external, and FCNRB. Okay, so foreign currency non-resident account, this is maintained only in foreign currency, the first one. It is maintained only in dollars. The NRI is putting that money for a certain locked-in period, 2 years, 3 years, 5 years. That means it is a kind of a FD type of account, term deposit. No demand deposit, only term here. Here it can be both, FDs as well as demand. Is that okay? And is that okay? And they can be maintained in rupees. Okay. For his NRI's transactions, for something like NRI's doing some transactions within the country. Suppose NRI is abroad, but he has houses in India. He's given them on rent. So all that rent will be credited in NRO, non-resident ordinary. For his local transactions, he will use NRO account. Is that okay? Is that okay? Understood? NRE is easily repatriable. Repatriable. That means that NRI fellow can easily take that money back in NRE. NRO can be repatriable, but there are a lot of conditions and difficulties. He will use that money whenever he comes to India. Is that okay? Okay, so this is about, see, there can be, see, everybody knows NRI accounts now. So you will not stop there. Okay, I think you got my point, right? So you'll not stop there. You'll go dig deeper in the Google research, like how many categories of NRE accounts are there and how do they operate. So basically, because UPSC the method of questioning has changed. So you should dig a little deeper. If that word is there in the previous paper, you have to dig it. That's it. Suppose FCCB is there here, means you will dig it. Is that okay? So fine, I'll come to GDR. See, these answer is 1, 2, and 3. You remove 4. Okay. So GDR, Global Depository Receipts, are part of FDI. According to government, government will include GDRs and releases its FDI data. Whenever government is releasing FDI data, it includes GDRs also. When RBI is releasing its data, you go to RBI and check the BOP account, RBI's data, you will find GDR in the FPI. But here the question is, can be included? Yes, according to government, it can be included. It is part of the government's FDI policy. Is this okay? Now, this is a change in the questioning. Earlier questions, you have seen how the questioning pattern was. Now, the way they are asking is completely different. That means when you're reading something, you'll not stop with the word. Got the point right. Earlier, if I know which one will fall, you can mark all the questions. But now I think you can't do that. So now it is interesting. Now it is more interesting that you can't guess without little knowledge and something. It's more research they want you to do. Okay, fine. Here, see here. ECB part of current or capital? Capital, because it is borrowing. Okay, so these loans are taken at market rate. These loans are taken at market rate, and generally corporates are borrowing. Okay, so it also includes a trade credit. If you dig deeper into ECB, okay, so it also includes a trade credit, that is importer-exporter related credit. Okay, that is also included in ECB. Is that okay? What else is included in ECB? No. External assistance is different from ECB. External assistance is something like a soft loan. ECB is a commercial loan. Both are different. NRI deposit. Masala bonds, okay. See here, trade credit is also part. According to RBI, see, RBI's notification is a little different. So here, generally, term is 3 years. That is what you see here. It refers to commercial loans availed from non-resident lenders with minimum overall average maturity of 3 years. It need not be always 3 years. That is what you'll remember. Second is, ECB can also come through automatic or non-automatic. That means there are restrictions. Why? Because our capital account is still not fully convertible. That means there will be restrictions on whatever is there in the capital account, right? Okay, then ECB is different from FDI in the sense that FDI is a foreign money invested to finance equity capital, whereas ECB is kind of funding other than equity, okay? And masala bonds are a kind of ECB where bonds are issued outside India but denominated in Indian rupees rather than the local currency, that is SDR. I will not. Can we have external debt in the form of SDR? Out of all our external debt, you would have seen that I've written there. Did I? I don't know whether I've written it or not. I've written it. Okay, so US dollar, rupee, then third would be SDR. Okay, so that is something which you have to remember. So third is SDR. Okay, so now you're able to follow, right? Right. So when we talk about Forex reserve, we said there is foreign currency asset, and then we have gold is there, okay, and we have SDRs, and we have RTP position, right? Okay, so tomorrow anyhow IMF comes up in the tomorrow's class, but this is also part of my Forex. Okay, so what is an SDR? SDR is a reserve asset. Reserve asset. Issued by whom? IMF. Because after the Bretton Woods failure, basically, so you wanted some liquid asset. So you cannot depend on dollar much, or you cannot depend on dollar completely. So one reserve asset which is as liquid as dollar you have come up with, and that is nothing but SDR. Okay, so then SDR value or SDR currency is decided based on weighted average of how many currencies? 5 currencies: US dollar, euro, pound, yen, and Chinese renminbi. That is something which you should be knowing. Okay, and our membership in IMF, okay, so is decided based on a concept called as quota. I will discuss quota tomorrow. Formula for quota, how quota is decided. So quota, and my quota is in the IMF. My quota in IMF is maintained in the form of SDRs. Okay, SDRs. Okay, so SDR can be expressed in dollar, euro, pound, etc. So SDR is not a currency as such, but SDR can be exchanged with any of the freely convertible 5 currencies. Exchanged. It is not a currency. It is a reserve asset which can be exchanged with any of the 5 liquid currencies. Is that okay? So that is what is SDR. And in the quota which I put in the IMF, and you can't put as much as you want. Basically, quota is, there is a formula. Tomorrow we'll talk about the formula in here. So out of the total quota which you have in the IMF, there is 25% of this quota amount in IMF which you maintain in the form of foreign currencies or SDRs. And this 25% of the quota, you can use it whenever you want. You can use this 25% of the amount which you are. See, to become a member of IMF, like if you want a membership from a gym, you have to pay membership fees. Similarly, you want to become a member of IMF, you're paying a membership fees. Okay, so but how much fees will I pay is decided based on your quota. You can't pay as much as you want. US has the highest quota. And quota will also decide the voting strength of a particular country. And out of the total quota which I'm pushing in IMF, 25% is maintained in foreign currency expressed in SDRs. Okay, and 75% is maintained in the local currency, our currencies. Okay, this 25% which I'm maintaining in IMF can be removed by India or any country whenever there is a need without paying any interest. There is nothing like a condition or interest to be paid to use this 25%. And that is nothing but my RTP. Is that okay? That is nothing but my RTP position. Is that okay? Yes. I'll come to depository receipts. Okay, so I've not discussed depository receipts. I'll discuss in the capital market. Global, Indian. So what are receipt holders? Who are receipt holders? And things like that. Okay, so here if you see, almost 555. Okay, so currency swap agreements we have signed with countries like Japan. So where we do transactions in our local currency. So whenever rupee value is depreciating, okay, so it can increase our costs. So better you sign such agreements like currency swap agreements. Okay. Till there. Okay. So when you use a word exchange rate, here there are two things. One, there is a concept called J curve. Okay. So one is J curve. Yesterday we talked about Laffer. So today we'll talk about J. In inequality, there is something like Lorentz. Okay. So here, first of all, when I talk about exchange rate system, exchanging one currency with another currency, in simple words. The rate at which I'm exchanging one currency with another currency. Okay. So from the beginning, we followed something like the pegged exchange rate system earlier. Okay. So I copied it from RBI's website only. So this is something like, we followed something like par value. Par value is where you're linking your currency with gold initially. So from par value system, later on we've changed to the pegged system. Is that okay? Pegged exchange rate, you're fixing a currency with one other strong currency. So I think you know that Bretton Woods system. Okay, so this is basically, we will call it as, I'll write it. So here you have three. One is, we have the fixed exchange rate system. Fixed exchange rate system. And then you have the floating exchange, or we use the word flexible. Flexible. And in this flexible, there are exchange rates where completely flexible, but India, we follow something called as managed float, or dirty float. Managed float or dirty float. So we are not completely leaving things to the market. Okay. So after the Bretton Woods system has been gone, so in the Bretton Woods system, how can you fix a currency? One, you can fix a currency by fixing your currency with a metal like gold, or you can fix it to a strong country. So dollar was fixing its currency with gold, and all other countries were fixing their currency with dollar. Is that okay? Okay? Okay, so this is what was happening. But after a certain period, what happened is, there was too much of increase in demand for dollar, and everybody started stocking dollar. Okay, so therefore, there was a problem with respect to US itself. US was itself facing deficits, etc. And therefore, this Bretton Woods system has been completely pulled away. And that is when different countries started moving towards, some started moving towards flexible. Okay, so that is when the risk associated with currencies started increasing, because you're leaving things to the market. So IMF role also started increasing during this period. Is that okay? Fine. Now, words like devaluation and revaluation are used in a fixed exchange rate system. And in a flexible exchange rate system, we use words like depreciation and appreciation. Is that okay? Depreciation of currency and appreciation of currency. So these are words used in a market system. This is used in a fixed exchange rate system. So devaluation, reducing the value of currency irrespective of market. So here it is reduced, the value of currency is going down because of the forces of demand and supply. It is because of the demand and supply graph. That is what you have to remember. Okay, so India's case, initially we followed par value system, 1947 to 71. Par value system means you're linking your currency with gold. Okay. Then 1971, Bretton Woods system has been pushed away because of troubles. So US was no more linking its dollar with gold. That is how the Bretton Woods system ended. Okay, and that is when India started linking its currency with pound sterling. That is what we did. Then 1975, instead of linking it with pound sterling, we started linking it with pegging our currency with a basket of currencies. Basket. And that basket was also kept secret. The weightages given to those currencies in the basket was also not revealed, because people may start buying those, there may be speculations, etc. Is that clear? Yes. Okay. So then RBI allowed domestic banks to undertake intraday trading and all that here. But 1992, okay, so in 1991 we had BOP crisis, and in 1992 we have come up with liberalized exchange rate management system. The word LERMS in 1992. So LERMS follows a dual exchange rate system. 1992, dual exchange rate is what? 60-40. Is that okay? So 60% I am doing it at market fundamentals, and 40% I will do it at whatever government rate is. Is that okay? So that is called as 60-40 rules, that is LERMS. So this dual rate, so LERMS was a transition phase for us. Transition. So after LERMS, subsequently, we slowly started moving towards market determined exchange rate system. Though we moved towards market determined exchange rate system, even today we follow only managed float or dirty float. That is, we interfere. Recently, IMF also warned India, because of your over interference only, that your rupee value stays high. Okay, so appreciation, depreciation is always with respect to a particular entity. It can be gold or it can be dollar. Is that okay? That is the reason madam says rupee value did not depreciate, but dollar value has appreciated. That means what she's saying is all other currencies value is going down when I compare with rupee. But when you compare with dollar, my rupee value is going down. So dollar is becoming stronger. It's not that rupee value is falling. So it is always about this comparison. Is that okay? So when we talk about exchange rates, one is we have something called as the nominal exchange rate. Nominal exchange rate. And then you have real exchange rate. Nominal, real exchange rate. And then we have nominal effective exchange rate and real effective exchange rate. And you also have something like the PPP exchange rate, purchasing power parity exchange rate. Okay, so we can't get into depth of this concept, but we'll try to figure out like what if a question comes up. So nominal exchange rate is not adjusted to inflation. And whenever you talk about nominal exchange, real exchange, it is comparing two different currencies only. Okay, so when I say effective exchange rate means you're comparing your currency with a basket of currencies. So that is first difference, right? Exchange rate, nominal, real exchange rate. Okay, so whenever your real exchange rate is appreciating, real exchange rate is increasing. So what should I say? Your trade competitiveness is so trade competitiveness of a country is decided through real exchange rate. Trade competitiveness, the statement comes up, trade competitiveness of a country is decided through which exchange rate? It is decided through real exchange rate, not nominal exchange rate. It is decided through real exchange rate. So can I express real exchange rate in the form of nominal? Can I write the formula? Of course, not the big formula. How do I get real exchange rate from nominal? Real exchange rate is nominal divided by PPP exchange rate. Nominal divided by purchasing power parity exchange rate. Okay. So, but when we talk about NEER and REER, these are indices. You're taking a basket of currencies. Basket. The basket can have 6 currencies or 40 currencies. Basket can have 6 currencies or 40 currencies. There was a previous question which was asked on NEER and REER. Okay, so here it is like the CPI index, WPI index, you put some commodities. Here you are putting currencies. You're putting currencies. Let's say I've put some 6 currencies in this. How much of these currencies I should shell out to get Indian rupee? This is what it checks. Simple logic. How much of this basket of currencies I should be selling out? How much of these currencies I should push from my pocket to get Indian rupee? This is what these indices will check. It is not how many rupees I should shell out to buy these currencies. It is how much of these rupees, these basket of currencies I should shell out from my pocket to buy 1 rupee. Are you able to get this? So that means if this index number is increasing, So index means it will have a base year. So base year is 2016. Any index should have a base year. Here also there is a base year. Base year is 2016. So if my index number is increasing, whether it is NEER or REER, if my index number is increasing, I have to shell out more of these currencies to get Indian rupee. It means my rupee is becoming stronger or rupee value is appreciating. I've got to the conclusion. We can't derive now. Okay, but I think for prelims, formula and derivation is not required. Okay, so here, if these index numbers are increasing, it means how much of these basket of currencies I should push from my pocket to get Indian rupee. So if the index number is increasing, more of these currencies I have to push from my pocket to get Indian rupee. It means index number is increasing means rupee value is appreciating. Index number is increasing means rupee value is appreciating. Is that okay? Understood? So this is a little typical concept, a little difficult concept in the sense if you go conceptually, but this is English here. See, NEER is weighted average value of nominal exchange rate rupee against the currencies of major trading partners of India. Okay, then REER is weighted average of real exchange rate. NEER adjusted to inflation is REER. Okay, both these indices, they are increasing. The number of this index is increasing. 100 is becoming 105, 110 means, that means you have to give more of these currencies, basket of currencies to get Indian rupee. Okay, so when I use the word purchasing power parity exchange rate, so you're taking a basket of commodities. This basket of commodities, you're making a comparison in two different countries. So a basket of commodities which I'm getting for $1 in US, the same basket of commodities, if I'm getting it for 30 rupees in India, basket of commodities I'm getting for $1 in US, the same basket of commodities I'm getting it for 30 rupees in India. It means my PPP exchange rate is $1 is equal to 30. Okay, so this is also one of the reason why when you measure India's GDP through PPP exchange rate, you find our GDP number will be more rather than the nominal exchange rate. Suppose you produce 10 pens, and 10 pen is, oh no, we'll not do that. Okay, so there is a, if rate of inflation in domestic market is more than rate of depreciation of a currency with other currencies of the world, other currencies, then can we say that currency has appreciated? So rate of inflation in domestic market is more than the rate of depreciation. So inflation is more means currency value will depreciate. So if inflation, direct impact of inflation is my value of currency should come down. Value of currency should come down. The doubt is like inflation in domestic market is more than the rate of depreciation of the currency. Inflation is more than the depreciation. So inflation is more than the depreciation of currency. Or then can we say that currency has appreciated? Can we say that the currency has appreciated in the real terms? See, if inflation is more means there will be more gap between REER and NEER. Inflation is more. Inflation is more means there will be higher gap between REER and NEER. Why? Because REER is always adjusted to inflation. Okay, inflation is more, higher gap. Okay, but now depreciation again depends on the basket of currencies. So inflation is accounted in the PPP. Inflation is accounted in the PPP. PPP is what? Purchasing power parity exchange rate. Okay, so is that okay? Inflation is accounted in the PPP exchange rate. So PPP exchange rate, so when I say nominal exchange rate divided by my PPP, so inflation is already accounted in the PPP exchange rate. Okay, so if my PPP is high, for example, $1, your $1 is, let's say nominal exchange rate is 70 rupees. Okay, but PPP exchange rate is 35 rupee. Okay, so that means here my real exchange rate will be 2. Is that okay? Nominal exchange rate divided by PPP. PPP is 35. Okay, nominal exchange rate divide. Is that okay? So here, whenever my real exchange rate is greater than 1, what will you do? Real exchange rate is greater than 1. Suppose this is 70, this becomes 140. 140. Okay, so that means you will export more. Got the point, right? Okay, so is this clear? Okay, so it depends on this number. It depends on that number. Okay, so suppose this becomes 35, then both will become same. Then there is no trade. See, this is called as law of equal price. This is called as law of equal price. 611, okay. So law of equal price. So law of equal price, see, over a period of time, this is what happens between two countries. Let's say US is there, India is there. They will do trade as long as this difference is there. But once the difference becomes same, suppose the ice cream becomes 35, here it becomes, and the exchange rate becomes, this becomes 70. Prices become same. Prices become same. Then no trade. Since it is 35, there is trade. Is that okay? So can we say currency has appreciated? Yes. In real terms, currency has appreciated. And when the currency appreciates, then trade will be less. Is that okay? See here, that's okay. That will not be asked. But is this clear? Understood? Now, this was the question they have asked. See, second statement say an increase in rear means I have to shell out more of my basket of currencies to get rupee. Means rupee is appreciating. If rupee appreciates, I'll become less trade competitive. Is that okay? So therefore, the second statement is wrong. You don't need any formula for this. You just need the index. So how much of this basket I am selling out? I have to shell out more, no, to get rupee. So automatically my rupee is appreciating. So I'll be less trade competitive. So second statement says improvement in trade competitive. This is wrong. Okay. And an increase in near indicates appreciation of rupee. Yes. Near or rear, increase in that index number means I have to shell out more of these currencies to get rupee. That is what is the meaning. So appreciation is there. Then an increasing trend in domestic inflation relative to inflation in other countries is likely to cause an increasing divergence between near and rear. So domestic inflation related to inflation in other countries. More is the inflation difference, inflation gap. More would be the gap between near and rear because rear is adjusted to inflation. Is that okay? So that is. Okay, so our rupee is only partially convertible. It is fully convertible with respect to current and partially convertible with respect to capital account. So capital account convertibility, there are recommendations given by Tarapur committee. So Tarapur committee is related to capital account convertibility. So Tarapur committee is very clear. He says your FD should be under control. GDP growth should be consistently increasing. Inflation should be below 4%. So all these are conditions to go ahead with complete convertibility. We have not gone ahead with complete convertibility still. Okay, so our rupee is only partially convertible even today. Okay, so this is about huge topic. J curve, heard of J curve? So what does J curve say? Okay, so whenever rupee value is depreciated, my current account deficit first increases. Rupee value is depreciated, current account deficit or trade deficit first increases, and only after that you will find an increase with respect to, so that means current account deficit is increasing, going below zero, that means my deficit is increasing, and then only after a certain period the benefit is there that your current account deficit becomes positive. It indirectly tells that my current account, whenever a currency is depreciated, the impact is first on my imports becoming costly. Then I am able to generate benefit in the form of increasing my exports. This is what is called as J curve. So this is financial market. This is also a difficult topic, and like the external, it's also huge. Okay, so when we say financial market, see, financial market can be divided into money market and capital market, both. Money market and capital market. Okay, so money market basically is short term. Money market, short term. Is that okay? And money market basically has both, only has debt instruments. It has both organized and unorganized entities. But generally we talk about organized. In the organized category, we deal with mainly who are the participants in the organized market. Banks are there. And you also have other secondary instruments. Okay, so other secondary instruments means we have these instruments like commercial paper, heard of them? Certificate of deposit, okay, commercial bills, okay. And in the government side, you have G's, sorry, no GSEC. We have treasury bills, T-bills, we have cash management bills, all are what? Money market instruments. Now, in the organized market, these bills will be discounted by banks. So those instruments which are there in the unorganized market, like hundi, once they have asked this, hundi is something like a commercial bill in the unorganized sector. So here you will have whom? Instead of banks, you will have money lenders, local banks or money lenders will be part here. Okay, and other instruments like hundi are there. Okay, so this hundi instrument is something like my commercial bill in the unorganized sector. But will bank discount this commercial bill? No. Banks will not discount because it is not operating in the organized market. It is unorganized. Once they've asked hundi. So hundi is also part of money market, but it is in the unorganized segment. Unorganized, not recognized by banks. Banks will not discount these instruments. Okay, so when we talk about these money market instruments, all are short-term debt instruments, and these are also called as discounted securities. Discounted securities. Do money market instruments have secondary market? Yes, you have Discount and Finance House of India, DFHI. DFHI provides a secondary market even for, this is handled by SBI basically. DFHI, Discount Finance House of India, provides secondary market. See, without secondary market, there will not be any liquidity. Okay, so you can't have liquidity. Unless there is secondary market, you can't expect liquidity. Okay, so on the government side, I've written treasury bills, T-bills. So T-bills can be, now today you have T-bills which are 91-day T-bills, 182-day and 364. 364, isn't it? That means you do not have 14-day treasury bills. Okay, so, and that is the reason if government has to raise money for a period of less than 91 days, then you have these bills which are called as cash management bills. So all are discounted securities. So discounted securities means they are issued at a discounted price and purchased at the original face value. Issued at discounted price, purchased at original face value. Do these instruments have secondary market? Yes, they have secondary market. So DFHI provides liquidity through the secondary market. So that is about the money market. And money market instruments are regulated by RBI. Obviously, organized money market instruments are regulated by RBI. Capital market instruments are regulated by this entity called SEBI. Okay. See, in capital market, here in money market, the transactions are in bulk transactions. You'll find multiples of 1 lakh, multiples of 5 lakh. So huge transactions. Participation of individuals is less. Though I can participate, but the participation will be less. But here the participation of individuals is more, and the transactions need not be in bulk. The transactions will be in smaller amounts also. Okay, so in the capital market, you have both debt instruments, but these debt instruments would be obviously long term. So we call it as government securities market. Government securities market. So in the government securities market, we talk about dated securities. Dated securities. So dated securities are one example of dated security can be GSEC, where the maturity periods are more than 1 year, generally 3 years, 5 years, 10 years. So we take 10-year GSEC securities as the standard. We take 10-year GSEC security as standard. Is that okay? And here we also have the equity markets. Equity markets. Okay, so in the equity market, again, you have the primary as well as the secondary. Primary market, and you also have the secondary market. So in the primary market, you're raising money, that is, the company is raising money for the first time. Suppose we call it as what? IPO, initial public offering. So in the primary market, is it that you only have public offers? No. There can be private placements also. You can only call some institutions to invest. You can only call some big players, like maybe you're only calling Rakesh Junjunwala or Ashish Kacholia. They will only come and invest. That is all private placement. You're not calling everybody. So individuals can also be there in the private placements. Okay, so here primary markets, you know these words, right? FPO, IPO. So these are something like the company is raising money for the first time from the market. That is IPO. So second time, third time, when it is diluting ownership and issuing new shares in the market, you use the word called FPO, all follow-on public offer. Okay. Now, when we talk about IPOs, a company cannot issue IPOs. So who issues IPOs? IPOs are issued by, IPOs are us. There is something like investment banks, merchant banks. Merchant banks. So merchant banks or investment banks are those companies most entities which will assist companies to deal with IPO. Is that okay? So I was working here only earlier. Okay, so that means your investment banking that is what you do, basically helping them sign IPOs and things like that. Okay, so is this clear? IPO, FPO, is that okay? Initial public, follow-on public offer. Okay, so then you have other entities. Other entities can also be there in the primary market. I'll come to that. Secondary market is ensured through stock exchanges like NSE, BSE. NSE, BSE. Other stock exchanges are also there. Or there can be over-the-counter derivatives also. Over-the-counter. That is, they're not traded. You're sitting across the counter and you're selling. That is what is over-the-counter. So what are the different capital market instruments? I can talk about bonds, long-term. Bonds here means you're talking about long-term bonds. Okay, so we can talk about derivatives. Okay, so derivative instruments. Then we can also talk about debentures. Heard of this word? Debentures, private debentures, companies, private entities. So debentures are called as unsecured loans. Unsecured loans. So, is that okay? So in the bonds, there are different types of bonds. Different types of bonds. We talked about masala bonds, inflation index bonds. Okay. So recently in news there were elephant bonds. Electoral in polity. So we're not interested in electoral bond, right? Okay. So here there are different types of bonds. Inflation index bonds are there. Okay. Yesterday we solved one question here. Okay. Talked about masala bonds. Masala bonds, okay. Negative yield bonds. Negative yield. That means you put money, you get less money. Like negative interest. Negative interest. For Japan used to come up with negative interest. Okay, you're putting 100 rupee, you're getting 95 rupee. Okay, so that is basically inflation index bond, masala bond, negative yield bonds, etc. So many bonds are there. Okay, so when we talk about masala bonds, these are rupee denominated bonds issued in other country. So what is the benefit of masala bond? Benefit is you're hedging currency risk. You're hedging currency risk. Okay, so currency risk is shifted from the borrower is the company, to the investors. Because of masala bond, the currency risk is shifted from the borrower to investor. Operation I can't explain, but I think you understood. Rupee denominated bond issued in other countries. Okay, so derivative instruments. So derivative market means I am selling a product at a predefined product, or I'm selling some securities at a predetermined date and price in future. Always remember, he cannot ask difficult questions in UPSC. So this is what is derivative market. So there are two types of market. One is spot market. Spot market means you are selling the product at the current market, in the current market. So today, spot market for potatoes. I'll get to know the spot market for potatoes in the mandi. Is that okay? Those who have not revised, it's like Greek and Latin. Okay, so spot market is something like the current price. Okay, and derivative market means I'm selling the potato or I'm buying potatoes at a predetermined price and date in future. Is that okay? Understood? Is that okay? So in the derivative market, you have different instruments like forwards, futures, options, swaps. UPSC 90% will not ask any difficult questions here. But at least you should know what is the derivative market. Derivative market means you're buying or selling a product or a security at a predetermined price and date in future. It is always future. It is always future. Okay, so forwards are not traded in the stock exchanges. They are always over the counter. Over the counter. Is that okay? Futures are traded in the stock exchange. In the regular class, we've seen how it operates. Okay, so futures is basically it is something like traded in the stock exchanges. Anybody can participate. What is the benefit of this future market? One, hedging. Hedging means what? Avoiding risk. Okay, two, speculation. So as individuals, most of us, we speculate in the markets. We speculate in the market. So speculation is also benefit only. Speculation can be negative. Speculation can also be positive. Okay, so option is something like if I buy an option, I have a right, but no obligation to sell or buy a particular security at the future date. Okay. This is right to buy. I'll write it. Right to buy / sell. Okay, but not obligated to buy or sell. Not obligated to buy or sell. Is that okay? It is right, but it is like there is a right to buy, but not obligated. Okay, so you have purchased the option, so you can execute it. So there are different types of options like call option and put option. You would have seen that in your material. What is call option? What is put option? Right to sell, but not obligated to sell. Is that okay? Call and put options. Okay, so swaps. So what is the meaning of derivative? Derivative market is something where you are doing it in the future. The meaning of derivative is a financial instrument which does not have value of its own, but the value is derived from some underlying asset. Some underlying asset is giving the value to that particular paper. Is that okay? So if at all, and who regulates the derivative market? Earlier it was Forward Markets Commission. Now it is only SEBI. There he will ask only such kind of question, I think. So we'll always be positive. Anything technical, remember, it will not come in exam. It will not come. If it comes, well left. We will leave. See, always remember this. Okay, if you feel that this question is very difficult, first think it will not come. If it comes, to baad mein dekh lete. If it comes, we will see. We will not mark in the exam. Though you prepare for that question, you can't mark. Few questions comes, one in 4 years, one is in 5 years. Such kind of question. You're not preparing for that question. That you'll leave that question. Or we'll guess that question. Okay, so spot market. Is that okay? In the current market. Selling something in the present market. Okay, so debentures are what? Unsecured loans. Debenture. So there was a previous question. Debenture holders are. UPSC was very kind earlier, you can see. Okay, in the money market, you also have interbank borrowings. That is called as the call money market. I think I did not write it there in a hurry. So even call money market, that is interbank, is also part of my money market. So that means banks are borrowing among themselves for a short-term period. 1 day, you call it call money, up to 14 days notice money. Okay, so this is also interbank borrowing. This you know, money lender, hundi. Hundi is what? Commercial bill. You don't have this 14 now. No 14. Remove that 14. Okay, so yes. And the commercial paper, okay, so generally 5 lakh. 5 lakh is the volume. So it's not 1 lakh. Okay, so here certificate of deposits also, now it is 5 lakh. It is not 1. RBI has changed it. Okay, so RBI has changed it, 5 lakh. Okay, so interbank call money market. So don't get confused, 5 lakh, minimum amount. So it is always in bulk transactions. Is that okay? No, that is different. Intermediate T-bills, see, intermediate T-bills are different. These T-bills are basically issued by RBI on behalf of central government only. Ad hoc T-bills, intermediate T-bills can be issued on behalf of state also. Obviously, but that we are not writing it here because that is for a specific purpose. They're not generally tradable. So here we are talking about tradable bills. So whenever there was a previous question in treasury bill, don't get confused. See here, treasury bills, G-Secs are issued by RBI on behalf of central government as well as state, right? But treasury bills are issued by RBI on behalf of central government only. This is a basic understanding of treasury bills. There may be some other treasury bills which is talking about. Okay, so that can be issued on behalf of for the state, but the regular treasury bill, no. Okay, T-bills do not offer regular interest. Previous UPSC question. They do not offer any regular interest. Okay, so why? Because that means coupons are not announced. Whenever a treasury bill is issued, there is no coupon announced. Whenever a G-Sec is issued, there is a coupon. 100 rupees bond, 10 rupee coupon. It is announced there. Okay, so but here it is not announced. It is issued at discounted rate and purchased at the original face value. But even money market instruments have secondary market. Liquidity is provided through DFHI. Is that okay? Yes, so there is a statement saying that no. Okay, so clear, right? Okay, so here there was one question. You will tell me. This was previous, I think 3-4 years back. I have not put the options. You will just tell which are right. Zero coupon bonds are interest-bearing short-term. See, when we talk about bonds, so when we talk about bonds, you have zero coupon or non-coupon. 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 That means these are non-interest-bearing bonds. No coupon announced. Non-interest-bearing bonds. Is that okay? But when we talk about G-Secs and these kind of instruments, these are all coupons. There is a coupon. There is a coupon announced. These are interest-bearing bonds. These are non-interest-bearing bonds. Is that okay? Zero coupon, no interest. Non-coupon, no interest. Okay? So, generally, money market instruments are zero coupon or non-coupon because there are no coupons announced. They are issued. There is no interest that is announced. They are issued at discounted rate and purchased at the original face value. So zero coupon bonds are interest bearing short-term bonds issued by the, so first of all, they are not interest bearing. Okay. Then call money is okay. Yes. Certificate of deposit is a long-term, gone. Anything in the money market cannot be long-term, simple. That is wrong. Okay. Commercial paper is a short-term unsecured promissory note. Yes. These are all unsecured. Is there any guarantee? There's nothing like a guarantee. Though they can be discounted by the banks, discounted, but still. Okay, so when we talk about, is that okay? Hundi. Commercial bill of the unorganized. Previous question. So just mug it up. You should know how a commercial bill works, okay? So in the capital market, I have primary and secondary market. So here in the primary capital market, means of raising funds in the primary market. So one is, we know IPOs and FPOs. Then we have private placement. So private placement means everybody will not participate. I think you got my point. Everybody will not participate, only closed group. And that closed group will be generally high net worth individuals. Nobody will call Aam Aadmi. Got the point, right? So when a company offers its securities to a small group, it is called private. Such securities may be bonds also. That is the reason, never remain as Aam Aadmi. Goal in life. Huh? So, no point. So, like, you are only called, means that is different. You know all the information. You know all the information, management, how he will work and everything, and therefore it is easy. Okay, preferential issue. Okay, so even preferential, it refers to a procedure of bulk allotment to fresh shares to a specific group of individuals, venture capitalists or companies. So you only have qualified institutional buyers. So when I use the word QIB, qualified institutional buyer, so heard of this word? Qualified institutional buyer. Okay, institutions. These are institutions which are qualified to invest. They are, who said you are qualified? SEBI. Nowadays, SEBI became very strict. No, on the YouTube, anybody is coming and saying, most of the time, these YouTube fellows are there who say, you buy this, you buy that, and they're giving all financial gyan to everybody. So SEBI got upset. Who are you to tell all this nonsense? You don't have any SEBI certification. Then why are you speaking on the YouTube? Really intelligent fellow will not speak on the YouTube. Okay, speaking on the YouTube, generally they're average fellows only. Why? Because you're getting money from speaking, not from investing. So SEBI also knows that. True, no? Logical, no? So you of course they make a lot of money, but they are speakers. Okay, so that is what I feel. Okay, so that is the reason mostly they go wrong, and SEBI also feels like you're doing too much. Okay, so be careful. That is what SEBI told recently. Okay, so you can't go ahead, and SEBI is, so that is the reason everybody is saying, this is not an advice. I'm not an I'm not a SEBI certified fellow. Every fellow is making this line very clear. Okay, so I think it is clear. So when I use the word qualified institutional buyer, means these are institutions like mutual fund institutions, banks, pension fund institutions, who have the experience already, and they are said you are qualified by SEBI. SEBI said you are qualified. Okay, so they will only invest sometimes in the private placements. Everybody, retail investor will not invest. Is that okay? So then you will find some terms like bonus issue, rights issue. Rights, R-I-G-T-H. So rights and bonus. Rights issue is what? The company is issuing shares to the existing shareholder. So already there are existing shareholders. Reliance wants to only raise 500 crore, which is a small amount for Reliance. So you get a mail in the morning. You, as an existing shareholder, you can buy the share at a little lesser price. And it is only for the existing shareholder. That is rights issue. But in the rights issue, you're paying some money. It's not free. Okay, but in a bonus means what? You're an employee of the company, let's say, and companies give bonus, but the bonus is not given in the form of money, but they are giving you bonus in the form of shares. That is called as bonus issue. Is that okay? Then there is something like sweat equity issue. Sweat equity issue is for your hard work. You are responsible for the company's growth because you have given them a patented product. You're a scientist or whatever it is. Sweat. your sweat, company has developed. So that fellow is giving you some equity, patent and all that. Is that okay? So these are some words which you come across in these discussions. So existing securities can be, so one is the spot market, then you have the forward market. So we have already talked about it, derivative market, always in the future. Who regulates the derivative market? SEBI. SEBI. Okay. So Sensex is an index of Bombay Stock Exchange. BSE is one of the oldest stock exchange. Okay, so index means index always has a base year. Similar like the CPI. So Sensex also has a base year, 1978-79 is the base year of Sensex. And Sensex base year has never been changed. So that means basically when you are saying 1978-79 is indexed to 100. So today if I say 72,000 is a Sensex, that means Sensex has grown by almost like 720 times. Got the point, right? Okay, what does Sensex indicate? It indicates market capitalization of top 30 companies. Market capitalization. So what is market capitalization? The total number of shares multiplied by the price of the share. Market capitalization is total number of shares multiplied by the price of the share. That is market capitalization. So what does Sensex indicate? It talks about market capitalization of the blue chip top 30 company, not everything. Top 30 companies. Similarly, Nifty 50, Nifty Junior, these are all indices of the National Stock Exchange. Is that okay? Okay, so it talks about market capitalization. Okay, till there. Okay, so here, this is earlier how the paper was. This is how the paper was earlier. So that time general studies was general. So you can, with your logic, you can mark. Now also you can mark with logic, but if you're not under pressure. If you're under pressure, then you will not be able to mark. You should not be under pressure. That is the first and the most important thing. When you're going to the exam, it's okay, go. Okay, so you go with the attitude like, once you're prepared, I'll get into. If you're not getting, you'll become a billionaire. Okay, so if I'm getting it, I'm becoming a government servant. Simple, the logic is very clear. Logic is very clear. So IAS officers will also come to us probably. So, that attitude, not overconfidence. At least that will something you keep in mind so that the stress will be less. I don't know how you do it. Somebody is enjoying the process, there's no stress only. But if you're like, oh, debenture. Okay. 2-3 questions. CSAT especially. You will fumble in CSAT if you're under pressure. So understand that most of them in India, they can't clear CSAT. Okay, so if we are practicing well, definitely we will clear. So that confidence, if you're really practicing, you can't give an exception, like you can't say maths I can't do, nothing like that. If you put real effort, CSAT, we will qualify. You're not putting effort, we will not qualify. You can't say I don't know maths, I've not studied, no, nothing doing. Because it is not added, no, you have to qualify. Of course it is difficult, but if we practice, you can. So that confidence, and you also remember, all of the others who are sitting in the room will fail. I am the only brightest. All others are useless. Okay, so that is the approach. Basically, otherwise you will feel tensed in the exam unnecessarily. And 5 marks you mess up, and again you write. 1.5 years. Yes. Okay, come back. We don't have time now. Okay, so this was a previous question. Now this, what is the answer? Bond holders are creditors. Okay, so debenture. Then there are a lot of words. Bull market, bear market. Okay, so bull market, generally the market is moving up. Bull. So bulls have a positive attitude. They believe that the prices of the shares will increase in the future. So what they will do? They will buy low, sell high. Buy when the price is less, sell when the price is high. You're expecting that the prices are going to increase. Okay, so that is basically bullish, bearish. Bull, bear. So because there are generally what will happen is people invest in the bull market and they feel that they are great investors. But once you are in the bear market, you'll understand how you can lose money. Okay, so bull is always like this attitude. Bearish attitude, markets. Markets are like this, no? Like the life. Up means you should fall. Got the point? If there is bull, there will be bear. If you're moving up, you have to fall. Remember this. Okay, so now the bull investor. So here I think, so what is the answer? So what is the answer for this? A. Okay, so then he thinks that the prices will fall. Now, here if you want to make money, current affair, one word should be short selling. So this fellow makes money in the bearish market. So Adani and Hindenburg. Adani and Hindenburg is a short selling entity. So short seller, what he will do? He will sell first, buy later. Short selling. Short selling is purely intraday. Intraday, short selling. Okay, so sell first, sell. You first sell. Without having it in your pocket, you can sell. Without having the share in your pocket, you can sell first and buy 330, buy. Though you don't buy, it will come into your account. You have to get it. So sell when the price is high. Okay, sell when the price is high. Buy when the price is low. Reverse. If he's asking this word related to stock market, they make money where? Bearish market. Bearish market. I think the word is clear. This is, I think, last year. Okay, so last year, this is the question. So beta is a number, always remember. When you open a stock, you find a number. So beta indicates the volatility of the stock. Beta indicates the volatility of a stock. So what does this beta number show? Beta can be 1.1, less than 1. Okay. So always any company can have a systematic risk. Okay. And it can have some unsystematic risk also. Unsystematic and systematic. So systematic means with respect to market. Markets do well, they do well. Markets fall, they also fall. Unsystematic is only they are falling because of their own mistake. For example, Kotak Bank recently, software issues or whatever it is, RBI said you're useless, and therefore next day all the shares were dropping. Okay, so RBI was warning them since last 2 years. So it is only for Kotak, it is not for the banking industry. So this is an unsystematic risk. Systematic means with the market. So this is basically when the number is high, you grow more than the market. Your prices number is high means your share price is increasing by X, market is increasing by X, you are increasing by X plus 50. You're more volatile. But you're falling, but the market is falling, you fall below the market also. They will be fluctuating like this. Generally, small cap companies happen, they move like this. So you're moving like this means you're more volatile. Your beta is generally more than 1. Beta is less than 1 means you're less volatile. Okay, that much you remember. Okay, so that is. It goes on and on. Okay, so I'll come to that. So there are a lot of words here. Okay, so one by one we will do. Okay. So one is depository receipts, or we call them as DRs, depository receipts. Depository receipt holders have voting rights. Theoretically, they have voting rights. Okay, so depository receipts can be one, we have GDRs, Global Depository Receipts, and ADRs. And we also have IDRs. IDRs are Indian Depository Receipts. Since our capital account is not fully convertible, an Indian company cannot directly raise money by listing its company in the US market. So instead of that, what the Indian company will do is Indian company X will go to a depository in US. It will go to a depository in US. Okay, this depository is in US. And based on the valuation of the shares, this depository in US will issue some receipts. It is issuing receipt. So this receipt value is decided based on the valuation of the shares. Okay, but this receipt is not share. It is a kind of a derivative only. That means this receipt value is coming from shares. And the investors in US will buy these receipts by paying dollars. Is that okay? And these receipts will be traded in those stock exchanges. So it is a mechanism through which an Indian company is raising money from the US market in dollars through the route of depository. This is nothing but what? ADR, American Depository Receipt. Is that okay? So tomorrow, if the laws are changed, we are coming up with new gifts. Ahmedabad gift city. So all that is what? You directly they can buy. Okay. So this is ADR. In the European market at the global level, when you do, it is GDR. GDR, Global Depository Receipts. Is that okay? ADR, GDR. Similarly, if a foreign company is able to raise money from the Indian market in rupees through the depository route, we use a word called IDRs, Indian Depository Receipts. Okay, according to government rules, GDRs are seen as part of FDI. Previous UPSC question. Okay, according to government rules, GDR is seen as part of FDI. According to RBI rules, this GDR will be seen as FI. Portfolio. Is that okay? Understood till there? Okay. Arbitrage. Arbitrage is something like selling a product at a, so you are taking the benefit of price difference in two different markets. Price difference. Okay, so here you can see, refers to buying some asset and simultaneously selling in other market to take advantage of price. Suppose I buy tomatoes in Karol Bagh. My famous example is, I buy tomatoes in Karol Bagh and sell it in Connaught Place. Okay. This is what I'm doing while going back home because I felt that tomatoes in Karol Bagh are cheap. I fill my car with tomato, I'm dropping them in Connaught Place. Okay, so this is what I'm doing. If I'm doing this is what is this? This is nothing but arbitrage. I am taking the benefit of the price difference in two different markets. Seeing me, all of you did. You also started following me. You started buying tomatoes and selling it in Connaught Place. And you started making money. This is what is arbitrage. That means I'm taking the price difference in two different markets and selling. Securities also you can do. Items also you can do. I can do it only for a certain period. Obviously, what will happen if everybody is buying tomatoes in Karol Bagh, then what will happen to the demand for tomatoes in Karol Bagh? Increase. So what will happen to price? Prices slowly start increasing. And everybody, all of you are also pushing the tomatoes to Connaught Place. Means in Connaught Place, what will happen? Supply will increase. If supply increases, then prices will drop. And then there will be a situation when there is law of equal price. Both the places, the price will be same. Then I will not take the tomato. Finished. We will stop this activity. We will not do this. This is what is arbitrage, using the price difference. So that is arbitrage. But when I say speculation, speculation means buy, hold and sell. I buy today, I hold it for a certain period and then sell. That is speculation. Is that okay? Then short selling, sell first, buy later. Sell first in the market and then you buy later. Okay, you're selling first and then you're buying. You're selling. It's intraday only. Morning you start, evening by evening the trade is over. Is that okay? Yes. So you know what is a bear market and a bull market? There were questions on this bear and bull. You know about beta also? see, hedge funds are not for everybody. Okay, so hedge funds are not for everybody. It is only high net worth individuals will invest. They will take a lot of risk. Okay, so it is not like, so it is not for everybody. It's not like the mutual fund. Okay, so hedge funds are risky funds. Risky funds. You're coming with hedge funds, that means you'll not depend on retail investors. You'll go to those who can take more risk, etc. Okay, so insider trading is wrong. Insider trading is wrong. Basically, you have the insider information and which others do not have. And therefore, you maximize on that. That is a benefit when if you become a bureaucrat, you get into power, you will have the insider information where the projects are coming, etc. So there you will be buying your lands, real estate. That's how it is. But you don't speak that out. But that is what happens. Because of your network inside, you know, like this project goes from here. The common man will get to know maybe after 1 year. By that time, already the land price would have gone 5 times. Okay, so they can't do anything. You'll remain common. Okay, so I think got the point, right? So similarly, directors of a company also, they may have some insider info using which they will decide on the trades. And that is wrong. Insider trading is illegal. You will be put behind bars. US, there were some scenarios also. Over the counter means not traded in the stock exchanges. See, there are 2 types of shares. One is the equity shareholder and another one is the preferential shareholder. Okay, so equity shareholder, and preferential shareholder. Okay, so who are real shareholders? Real owners. They are real owners. They will have what? Voting rights. They will have voting rights. Okay. So then why the company wants them? No. Company wants to raise capital without diluting ownership. Without diluting ownership, it wants to raise capital. That is why preferential shareholder. Okay. And they are not real. They do not have voting rights. They can't vote in the annual general meetings, etc. Okay. They also get a fixed dividend. Fixed dividends. Here, dividend is not guaranteed. If the company gives, you have to take. If the company is making profit, it may give. May or may not. If it gives, you take it. Otherwise, keep quiet. This is equity shareholder, and that is preferential shareholder. Words are important to identify. That's it. The word you know, you're identifying it. Okay, if that word comes up, we are okay. In the last class, I'll give you some words I told you, like some other words also, which are there in the news. So venture capitalist, angel investors, both of them fund risky startups. Both of them fund risky. Venture capitalists will come later. See, in India, what will happen is, if you're doing well, you're a hero. Example, Baiju. So everybody said, what? And they said, what does Baiju eat? What is the daily schedule of Baiju? This is how they are. They're crazy people. Okay, so, and then when he falls a little, then you push him down. Okay, so you push him. I thought long back, so that he will fall. Okay, so this is a loose talk. So this is how, and of course, all the venture capitalists or these investors, they will not be kind, obviously. When they give you money, they want share. And if you're not okay, they want to grab your company. Grab. I think you got the point right. So they are basically, but venture capitalists will come a little later, unlike the angel investor. Angel investors generally give seed capital. Both of them fund risky startup. And angel tax, I think the word is clear. Okay, take a break. Okay. Shall we start? So the next topic. Poverty and inequality. Okay, see, poverty can be defined as a condition in which an individual or a household lacks the financial resources to afford a basic minimum standard of living. Okay, so when we talk about poverty, so here we are referring to something called as absolute poverty. Deprivation with respect to basic requirements for leading a dignified life. Okay, so this absolute poverty, how is it calculated? Okay, so one is earlier, this food calorie method was made popular. Food calorie method was made popular. Okay, so where we talk about 2,400 calories in the rural areas and 2,100 calories per day in the somebody who's getting less than this. This is the food calorie method, which is a not a good method, in fact, in the sense like poverty cannot be just checked through calories. Simple. Okay, but most of the committees earlier were using the food calorie method. But the better way of measuring poverty, so then they started taking a poverty line basket. Okay, so how do you build a poverty line basket? You put all the important commodities. You'll also put health, education, and other things in this basket. And you'll try to arrive at a monetary value for this basket. Monetary value for this basket, let's say monetary value is 400 rupees per day. Sorry, per month. Okay, and all those whose per capita consumption expenditure is less than this line are treated as below poverty line. Above this, above poverty line. Simple way of expressing. Okay, so head count ratio. Head count ratio. So it will measure what? It measures incidence of poverty. It will tell us how many are poor. It will tell us incidence of poverty or how many are poor. So what percentage of population are poor? Simple logic. So here, let's say out of 10, 2 are poor, below the poverty line. So you're saying what percentage of population are poor? It only measures incidence. But you'll not be able to measure the intensity of poverty. So intensity of poverty measures how poor they are. So intensity of poverty is measured through poverty gap ratio. Okay, poverty gap ratio. And it is also measured through a squared poverty gap index. Square poverty gap index, right? Poverty gap ratio, squared poverty gap index. What is poverty gap ratio? What is the formula for poverty gap ratio? Poverty line minus average consumption expenditure of whom? BPL households divided by. So it will tell you how many are poor. Okay, so whenever government is focusing on some transfers, so it has to know the poverty gap based on which it can decide how much can be given in the form of transfers. Okay, but if I want to compare two small areas, and you also want to adjust to an aspect of inequality to some extent. Okay, I'll not calculate, I'll not write the calculation here. We use which index? Squared poverty gap index. We have seen this, we've assumed two countries, and though the head count ratio and poverty gap ratio may be same. So there are two countries. Okay, so let's say Karol Bagh and Connaught Place, our favorite places. Okay, so you will observe that in Karol Bagh also there are two people who are below the poverty line. In Connaught Place also there are two below the poverty line. Okay, so head count is same, head count ratio is same, because the percentage of population below the poverty line is same. This is the poverty line. Okay, but head count ratio is same, but at the same, even the poverty gap ratio can also be same sometimes. The poverty gap ratio is same, head count is also same. Then we use what? squared poverty gap index. So we square this number, which is, so we are squaring a number. So the gap between the poverty line and this entity. So higher is the gap. When I square that number, it will intensify. Lower is the gap. When I square, it is less. This is what we do. No? 0.5 square is different from 4 square, right? 4 square, it becomes 16. So as and when the gap is increasing, I'm showing a higher value for them. But as and when the gap is less, it becomes 0.25 when I square this number. Okay, so when the gap is less, I'm reducing it. Okay, so this is how we are going to measure poverty in the squared poverty gap index. So both of them measure the intensity of poverty. Intensity, including inequality, you will be able to do in the squared poverty gap index. Is that okay? Yes? So I don't think they will ask this, causes of poverty in prelims. But causes of poverty, there is something like historical factors like caste or even colonial rule, etc. Okay, so, and you have economic factors, lack of employment opportunities, incomes, etc. Okay, and structural problems in the economy and structural reforms also, and high population growth, etc. And failure of trickle-down theory, failure of trickle-down, the benefits of growth were not reaching the leakages in the government programs and schemes, etc. So that is also there. Okay, so all these are what reasons for poverty. There are many reasons. Okay, and we have used a word called Matthew effect earlier. Matthew effect is something like you're coming up with a program, government is coming up with a program, but the benefits of the program are taken away by somebody who already has some resources, whether it is education, land, etc. The real beneficiary is not getting the benefit. That is what is called as Matthew effect. Is that okay? Issues of stagflation, okay, and war, all these. Is that okay? Poverty trap, okay, so vicious cycle of poverty. So India is still here only. Okay, so this is basically, you can observe low income, low middle income, upper middle income, and high income groups. So we're saying by 2030, 2031, probably we will move here, upper middle income. Okay, so is that okay? Yes. Now, there are different ways of measuring poverty and different ways of measuring poverty here, and different committees have come up earlier. For example, the first committee, Dadabhai Naoroji was the first entity, like he has come up with measuring poverty. And first systematic assessment of measuring poverty was done by Dandekar and Rath committee. Systematically done, first systematic assessment. So earlier there were several other entities like OJA panel, okay, Mount Singh Howlawalia. Okay, you have all these committees also who have come up with, and primarily they were using food calorie as a standard. Food calorie was the standard for measuring poverty. Okay, and here if you see, Dandekar and Rath committee, it came up with a unified value for urban and rural areas. 2,250 calories in urban as well as rural. Okay, somebody who's getting less than that, you're calling them as poor. Okay, so this is what Dandekar and Rath did. Okay, then after Dandekar and Rath, see 1971, okay, then Alag committee. So Alag committee basically has bifurcated rural and urban. So that is basically 2,400 and in the rural and 2,100 in the urban. Though food calorie was taken as standard, but there is a bifurcation. Dandekar and Rath was using 2,250 calorie for rural as well as urban. Is that okay? Okay, then Lakdewala committee, what you will remember in Lakdewala group committee, Lakdewala committee is basically what it did is, one is it has come up with a state-specific poverty lines. Is that okay? State-specific poverty line, because based on inflation, you have to adjust it to inflation. So state-specific poverty line was included through Lakdewala group. And retain the separate rural and urban poverty lines recommended. So you're coming up with a separate poverty line basket for rural as well as urban. Okay, so separate poverty line basket for rural. That means the basket is different. Poverty line basket will be different for urban and rural. So all these committees were using a different basket. Different basket. So for all the urban areas, I will use this basket. For all the rural areas, I'll be using this basket. Okay, but though the basket may be same in different urban areas, the poverty line may be different because it has to be adjusted to inflation. Simple logic. So if I have to adjust it to inflation, inflation is different in different places, so obviously it will be different. So Suresh Tendulkar committee, which we take as the most standard. So what were the main recommendations of Suresh Tendulkar committee? So Suresh Tendulkar committee came up with few important recommendations. One is it has identified that earlier committees were giving too much of importance to food calorie. So what he says is slowly move away from food calorie. Slowly move away from food calorie. He says continue with per capita consumption expenditure. Per capita consumption expenditure method. So you can calculate poverty using income or per capita consumption expenditure. But this is a better method. This is always seen as a better method because people without income also consume. For example, old age and children. So per capita consumption expenditure method, continue with it. Then he also says health and education should be given adequate importance. Health and education, it has to be given adequate importance in the basket. So you can't leave it to the state. So health and education should be given adequate importance, and that is one more suggestion. Then one more important suggestion is he takes a same, he says take a same urban poverty line basket, take the same urban poverty line basket and use it for the rural. So he is talking about a uniform poverty line basket for urban and rural. Uniform poverty. This was asked in CDS 2024. This was asked in CDS 2024. So use the same urban poverty line basket and use it in the rural. Okay, so he says unified poverty line basket for urban and rural. And he says do away with crude price adjustments. Crude price adjustments means adjust your baskets properly with inflation. Adjust your baskets properly with inflation. This is what? See, he did not calculate separately. He will take the Lakdewala method, Lakdewala thing, and he will change. So what did he change? So one, he also says shift from a methodology that is uniform recall period method, which you are calculating, to mixed recall period. So what he does is he takes the data of Lakdewala and he uses MRP method. Uniform recall period. What is uniform recall period? All the items, food as well as non-food, you are calculating it for a 30-day recall period. That is uniform recall period. Mixed recall period, 5 non-food items, footwear, clothing, education, institutional medical expenses, and consumer good, consumer durables. All these 5 non-food items calculated for 365 days. 5 non-food items calculated for 365 days recall period, and rest you will calculate it for 30-day period. Is that okay? So that is what MRP is. Okay, so and Suresh Tendulkar committee also suggests shift from URP to MRP. That is also so. Is that okay? So this is what Suresh Tendulkar, we take him as standard. Okay, we take him as standard. Okay, so now Rangarajan committee is a little different from Suresh Tendulkar. So he says we will not take a uniform poverty line basket for urban and rural. We will take a different poverty line basket for urban and rural. This is one. And he comes up with modified mixed recall period. Modified mixed recall period, which we also call it as MMRP. Modified mixed recall period. That means here you have 7-day recall period, a 30-day recall period, and 365-day. So regular purchases like pan, masala, that is also there. Okay, so or vegetables, these things you will put it in the 7-day recall period. So you have 365 days, those 5 non-food, and 30-day, that is called. And one more important thing is, for the first time, not just about calories, there is also a discussion about fats and protein in the Rangarajan panel, Rangarajan committee recommendations. Not just calorie, but fat as well as protein to be considered here. So calculation using Rangarajan, you will find that the poverty is a little higher. Is that okay? So that is about the different, there can be some questions suddenly that can come up. Okay, so this was some question which was asked. Oh, no. Okay, so like this, see, sometimes we never know. Okay, so it's like, oh, committee, I'll not read. But if you're not reading committees, you'll at least read Suresh Tendulkar and Rangarajan. So you can't say, I will not touch any committee. That is the reason I pushed this question. Okay, so this is recent only. So that means anytime he may do something. So you should be in a position to identify. 2011. Okay, so multidimensional poverty index. Heard of this? Okay, so one is global multidimensional poverty index. Our government was saying like 25 crore people are pulled out from multidimensional poverty. Of course, that is National Multidimensional Poverty Index, which talks about 12 major indicators. So in the Global Multidimensional Poverty Index, you have 10. Okay, so any factual question can come. So launched in 2010 by UNDP and the Oxford Poverty and Human Development Index. The methodology, there is a method to calculate that's not required for UPSC Prelim. Okay, so Oxford Poverty Human Development Initiative. The MPI is measure of multidimensional poverty covering more than 100 developing countries. Okay, it goes beyond income as a sole indicator. So it is basically checking deprivation of few important aspects like health, education, and living standards. So obviously each one will be given 1/3, 1/3, 1/3 weightage. And then you separately divide them, right? You have 10 indicators here. There you have 12 indicators in the National Multidimensional Poverty Index. What are the two other indicators? Bank, maternal mortality. Yes. These are the two additional indicators in the National Multidimensional Poverty Index. Is that okay? So here a person is multidimensionally poor if he is deprived in 1/3 or like 33% or more of the weighted 10 indicators. Then you are calling him as multidimensionally poor. Okay. Okay. Now, government's method, see, poverty eradication, it will take time, but India was it successful means India was partially successful with respect to handling poverty. Okay. So partially successful with respect to handling poverty. So growth-oriented approach. This is basically, so one problem with India is till the 6th 5-year plan, we did not have a specific focus on unemployment, etc. Madam, in 1970s, she has come up with the slogan, it is not Indira Hatao, it is Garibi Hatao. So that means till early 70s, we did not come up with a specific strategy for poverty alleviation. Okay, so we believed that the growth will bring in inclusiveness, or we believed that the trickle-down theory will work, but the trickle-down theory actually failed. So expectation that the rapid increase in GDP and per capita income will trickle down and spread to the sections of the other sections of the society. That did not happen as expected. Okay, so in the planning class, we will see which 5-year plan, which one they have come up with. So then asset creation and work generation. So this basically you started focusing on building infrastructure, etc., and coming up with rural employment programs and other programs here. Okay, so here provision for minimum basic amenities. So once your buffer stock is full, then you could come up with schemes related to FCI. Is that okay? So here can be traced from the 5th 5-year plan onwards. 5th 5-year plan onwards. Provision of food grains at subsidized rates, education, health, water supply, and sanitation. Okay, and major programs aimed at improving the food and nutritional status of the poor. PDS, ICDS, etc. So this is another area. So the agriculture class, we will trace agriculture, that time we will see, but public distribution system, so you know what is a public distribution system, right? Okay. Did not produce the desired outcome. Okay. Recent initiatives, MGNREG and all that, midday meal schemes, National Food Security Act, financial inclusion. Is that okay? Yes. Okay, till here I think yes. I'm just thinking anything is there. If anything is left out also, we'll add it up in the last class. Okay, so we'll add it up in the last class. It can happen like we missed out something. So what we will do is, I think Monday is the last class, right? Sunday? Sunday. Okay, okay. Okay. So last class, whichever. Like, okay. I thought Monday. Okay, so I don't know. I thought it's Monday, but I'll see. I'll check. Okay. Now talking about inequality. Inequality. So here, what are the questions they can ask? One is they can ask Palma ratio. Okay. So another one is Lorentz curve, Gini coefficient. That is one more area. Okay. Or what are the other ways of measuring poverty? Quintile ratio. What does quintile ratio check? Decile is top 10, bottom 10. Okay, quintile should be top 20, bottom 20. Is that okay? Quintile, decile, quintile. Okay, 20 to 20. Okay, top 20, bottom 20 you are comparing. That is quintile ratio. Okay. Inequality is not, it is a state of not being equal. It can be with respect to wealth, opportunities, access to education, health, etc. Okay, so when we talk about inequalities, it can be social or economic inequality. And social inequalities will lead to economic inequality. Economic inequality will lead to social inequalities. Okay, so here in our economics, we are only interested in economic inequality. So we're not going to talk about regional disparities, etc., vulnerable sections, what are the problems, gender issues, etc. All are also reasons for poverty, no doubt about it. But here we are only talking about inequality in the form of income, expenditure, or wealth. Income, expenditure, wealth, that's all. Okay, and wealth inequalities are always greater than income inequalities. Wealth inequalities are always greater than income inequalities. Okay, fine. So when we talk about Lorentz curve, so this is Lorentz curve. Okay, so Lorentz curve, it is a graphical representation of inequalities, measuring graphical. Okay, Gini coefficient is an arithmetic expression. Gini coefficient is an arithmetic expression. Okay, so here I am taking percentage of population, here percentage of income. So percentage of population from poor to rich. So this should be like that. Okay, so if I'm saying top 20% of the population are holding, let's say, 80% of the wealth. So top 20, or it can be bottom 80. Are you able to get this? Okay, so here we are talking about from the poor to the rich. Okay, so here this is called as line of absolute equality. This is the line of absolute equality. So it's an imaginary line, obviously. This indicates that 10% of the population is holding 10%, 20 is holding 20, 30 is holding 30%, 70 is holding 70% of the wealth. Is that okay? Or income. Okay, so that is basically line of absolute equality. This will never be reality. Okay, so this is the Lorentz curve. And more is the inequality, you move farther away from the line of absolute equality. More is the inequality, you move farther away from the line of absolute equality. Is that okay? Yes. And now, highest inequality would be when this Lorentz curve, this is the Lorentz curve. This is the Lorentz curve. And I plot the Lorentz curve. So highest inequality would be when this Lorentz curve coincides with this line. Is that okay? Lorentz curve coincides with this line. That is complete inequality. Okay, so when 1% of the rich are holding 100% of the income. Is that okay? So automatically it will coincide with this line. Okay, so here we have written Gini is equal to A by, let's say this portion I'm taking it as B. or any of it is written BCD. Okay, so this portion. Okay, so total area you're taking. Okay, so is that clear? A by the total area, A plus B. Is that okay? So that is what is Gini coefficient. So if Gini coefficient is 0, 0 is what? You don't have the shaded portion. This curve is, so this is Gini coefficient is 0 is obviously there is no inequality. Okay, but when my Lorentz curve coincides with this line, okay, so that means my numerator will be same as my denominator. Is that okay? So that means Gini coefficient will range between 0 to 1. 0, least inequality, 1, highest inequality. Okay, there was one statement earlier they've asked, okay, so that if your Gini coefficient is high, indicates that inequality is less. That is a wrong statement. Is that okay? Yes. Quintile ratio is always, remember, average income of top 20% to the poorest 20. So in the class we were plotting. Okay, so 20-20. Palma is different. Palma is you're comparing top 10% to bottom 40%. If it is 10 and 10, it will become decile. So that is what you'll remember. Palma is 10 and 40. Okay, so in mains we use them. So now, is that clear? So then one more important entity here, Kuznets curve. See, Kuznets curve, you will learn Kuznets in the environment also. You would have come across this in the environment class also. So here, Kuznets curve provides a way to study relationship between inequality and economic growth. Inequality and economic growth. As and when you're growing, inequalities tend to increase. You can observe this graph. As and when you're growing, inequalities tend to increase. You can see here, Kuznets curve provides a way to study relationship between inequality and economic growth. Okay, it says that as the economy grows, inequality increases in the beginning. Inequality increases in the beginning, and then it decreases with further growth in the economy. So countries generally talk about inclusive growth, all that, sustainable development and all that at this level. Okay, so once they grow. So every country is at a different level. So that is the reason you can't have uniform policies. For example, already there are some countries which have grown to a great extent. And there are some countries which are growing. So you cannot have uniform policies across. Okay, so generally it means as and when the incomes are increasing, inequalities will increase. Why? Because there will be shift from primary to secondary sector. There will be migration from rural to urban areas. And there will be differences in wages. And therefore, inequalities are bound to increase. And after attaining a certain level of growth, then the concept of inclusiveness or inclusive growth comes into picture. I hope it is clear till here. Understood? Yes. What measures have been taken by the government to handle inequality? Now, sitting here, we can say 5 years down the line in India, inequalities are going to increase. Okay, so why? Because we can observe inequalities will be less when government programs are more efficient. Two, if you want to handle inequality, two factors. One, education and health. Three, social security. As long as you're not able to handle these, okay, so you cannot ensure equality. Okay, so there were several mains question so what did government do from the beginning? So one is you have come up with PSUs, okay, land reforms, okay. Then what else? Okay, 5-year plans, yes. Planned economic model, we call it as, right? Planned economic model. Then FCI, etc. Stringent labor laws. Okay, so started focusing on agriculture, etc. Okay, believed in heavy industry model, but that heavy industry model has rather backfired. Okay, or PSU-led growth model, which we decided that created a problem. Progressive taxing. It was extremely progressive, huh? Where our highest rate went more than 97%. Okay, so this is called as progressive taxing. Social security, provision for minimum wage rates, provision of free of cost education and health. Provision is there, but health education is not there. Gender budgeting. Okay, so encouraging labor intensive sectors, but here also we failed. That is the reason our growth model was capital intensive rather than labor intensive. But coming up with this, obviously it is good because it will create more jobs. Impact of inequality. So relative poverty will increase. Lack of access to health and education erodes social cohesion. Lack of political rights. See, when we talk about poverty also, so poverty cannot be handled primarily with income. That is the reason World Bank's method of income method for deciding extreme poverty does not work out. And when you're comparing countries with respect to poverty, you take which exchange rates? Purchasing power parity, exchange rates. Is that okay? PPP exchange rates. So why? Because when we talk about poverty, it talks about multiple aspects. One, it has to deal with social security, lack of access to social security. Okay. So then there are problems with respect to access to health and education. Three, there is challenges of lack of access to political rights. Heard of this? No? Political rights, right to vote. Tribals don't have. Okay, so vulnerable sections being neglected, rights of tribals, etc., forest rights, etc. So your laws were going against tribals. Okay, so then, okay, handling calamities like COVID. Okay, so that is also a problem. That is also a challenge. Okay, then problems with respect to implementation of reforms. Failure of land reforms, etc., failure of trickle down. All these are reasons for poverty as well as inequality. So land reforms, if it is successful, it will reduce rural poverty, reduce rural inequalities. Okay, so that was also a problem. That means the initiatives which you have taken were not okay. Is that okay? Understood? Okay, so these are all reasons which you can identify. There's no much problem. Causes of inequality. Causes of inequality. These are okay, you can identify. I'll put. What are the causes of inequality? Can you tell me? Lack of jobs, issues of unemployment, jobless growth, structural reforms, informalization, okay, gig, lack of social security, etc. Okay, capital intensive, okay, lack of skills. So that is anyhow there. So that is poverty trap. So I'll put it as poverty trap. Okay, then any other reason? Trickle down. Okay, so policies of governments, there are issues, etc. Okay, so all these are probably you can identify, I believe. Like there should not be any. These are all English reasons only. So there should not be any trouble in identifying. Wait. There's one more document. Some words I wanted to give you. There should be one more document. Okay, so it's okay. I'll give you some words, simple words only, which one or two words extra. That's it. Okay, so LIBOR, London interbank offer rate, bond price and yield, what does rate on FD affect bond yield? Okay, talk about that. LIBOR is replaced with what? You'll read that is there in the current. And when you'll LIBOR, London interbank offer rate. Okay, it's not in use now. Alternate investment funds. What it is, you'll read. Alternate investment. So in SEBI exam, there was a question whether mutual fund is an alternate investment fund or not. No. Okay, so you read. Okay, so there's a statement, mutual funds are alternate investment funds. So mutual funds, you all can invest in mutual funds, isn't it? Okay, so that is what you'll read. Like alternate investment fund means you don't dig deeper. You'll just read what it is. You just read one paragraph and leave what it is. Collective investment schemes. Real estate investment trusts. Real estate investment trusts. Anyhow, InVITs I will discuss in the next classes. InVITs, last year there was a question on InVITs. Anchor investors. See, anchor investors are called before IPO. Remember this. They are called before IPO. Okay, so before issuing an IPO, you're calling some institutional investors to buy, and they will bring confidence. They'll bring confidence for that IPO. Is that okay? So that is basically called as anchor investor. Tobin tax, TOBIN. Tobin tax is basically levied on. No. This is speculative currency transactions. Speculative currency transactions. Speculative currency transactions. Is that okay? Participatory notes. Who issues participatory notes? FIs. It was a previous UPSC question. Okay, who issues participatory notes? FI entities. They are called as what? Offshore derivative instruments. Offshore derivative instruments. Value investing. Value investing. Hedge funds. What are they? Just read what are they. That's it. That's it. Is that okay? So this is not current. This is not current. Current words last day we will see. So in the current words and all, anything important, I will give a list. On the last day we will see some current words. See, there's one small doubt. Explain bond price and bond yield. Does the interest rate of FD affect the bond yield? See, bond price and bond yield are inversely related always. Huh? Bond price and bond yield are inversely related. Okay, so what are the factors that affect bond yield was a previous question. And there were options given like inflation, interest rates. Okay, and I think there was one more option like policies of federal bank. Okay, was there any other option? I don't know. I think all of the above would have been there. Okay, so inflation is there, interest rates, federal bank policies. Okay, so bond prices will also affect bond yields. Bond prices, and there is an inverse relationship between bond price and bond yield. Okay, so suppose there is a 100 rupees bond which is giving me a coupon of 10 rupees. Okay, so this bond is sold at 90. So here it is, the return I'm getting is 10 out of 100. Yearly I'm getting 10 rupees, let's say. So my yield is 10 out of 100. So here this fellow will get 10. So he'll get 10 out of 90 that year. So bond yield is something like, it is something like the coupon divided by current price of the bond. Current price of the bond is not constant. Current price of the bond is not constant. Price of the bond is not constant. Here the price of the bond is 100. Here the price of the bond is 90. Here my interest will become 11.1. Here my interest will become 10%. That means as and when my price is going down, generally the yield will increase. Is that okay? So a regular bond yield curve, if I look at a regular bond yield curve, the regular bond yield curve will look like this. This is my regular bond yield curve. If I take, here I'm taking the maturity period of the bonds, and here I'm taking the yield. As and when yield maturity is increasing, the bond yield is also, returns should also increase. This is called as regular yield curve. It's a general curve. Okay. Suppose there is a jump in the long-term bond yields. This is called as a steep curve. Steep curve. That means my long-term bonds are giving higher yield. Long-term bonds are giving higher yield. Is that okay? Then this is the same curve which has become steep. Huh? It's not the different curve. The same curve can become flat. This is called as a flat curve. Flat, that means this curve only, it can either go like this, or this flat curve can tilt in this direction, it becomes flat. Flat is what? Irrespective of the maturity period, the yield remains the same. That is flat curve. And this is called as inverted yield curve. This is inverted yield curve. Inverted yield curve is an indication in US that recession is about to come. That is what you'll remember. Inverted yield curve of US Treasury bonds is an indication that recession is about to come. Recession is at your doorstep. So why does this curve indicate that? Because the investors, whenever there is recession close by, the investors will remove money from the short-term instruments and they will put the money in the long-term. You're removing money from the short-term means, you're selling of short-term. You're selling short-term. When you sell short-term, is that okay? The price of the short-term bonds reduce. So the yield will increase. And you're buying long-term bonds, then the price of the long-term bond increases and therefore the yield is decreasing. Okay, so this is how inversion happens. Okay, now the question here is what you'll remember. Operation twist also is the same logic. See, to understand like FD rates, the question is on FD rates and all. So to understand FD rates, what is operation twist? This is a regular yield curve of GSEC bonds. So this was, through operation twist, the yield was reduced. Long-term bonds, let's say this is 10-year bond, yield has been reduced. How did they reduce? RBI started buying these long-term, this is long-term, buying long-term. You're selling short-term bonds, get 10,000 crore, use that 10,000 crore to buy long-term. Yesterday we've discussed what is operation twist. Sell short-term, buy long-term. You sell short-term, get 10,000 crore with the same money, buy long-term. Your buying means the price of these bonds is going to increase. You're creating demand. So when price increases, then yield will decrease. The yield has come down. So earlier yield was 7%. Now let's say the yield has come down to, let's say 5.5. This is what operation twist does. So this will make my long-term loans cheaper. Why? For example, just an observation. Let's say this is a bank. So you are putting your FD in the bank. So bank has some options here. One is bank can give loan. Okay, so or bank can also park the money in GSEC. It has an option. You can't say bank, you only give loan. Okay, so safe GSECs are also there and bank can also give loans. Suppose my GSEC is giving 8% return. And you are also giving loan at 8%. Then bank will decide unnecessarily don't give loans. Why? Because risk is there. Better put your money in GSEC. Okay. This is what is the logic. Okay. But suppose you are getting 11% here, then bank may think. When you are giving loans, is that okay? Now, what is operation twist doing? Operation twist is reducing this GSEC yield from 8% to, let's say, 5.5, just an example, 5.5. So banks, if they put their money in this, they will only get, let's say, 5.5. But if they give loan at 7%, they are getting 1.5% more. Are you able to get this? So when the GSEC yield reduced, it is making my long-term loans cheaper. Long-term loan, bank is giving long-term loan at 7% only, because when I'm putting it in the long-term GSEC, I'm only getting 5.5. So instead of doing that, I will give loan to customers and get 7%. This is what Operation Twist does. It is making my long-term loan cheaper. Is that okay? So that is the reason. Now, second is, if you are putting GSEC, in the GSEC you're getting 8, and bank was paying you 7% FD rate. Now you're putting in GSEC, you're getting 5.5. Then why should the bank pay you 7 is the question. Got the point right? Bank will also pay you less. Is that okay? So the bank pays you less interest. Let's say bank is paying you 6 only now. Okay, so why? Because it is getting less. So that means it's asking you not to save in the bank, go and consume. So my Operation Twist will also increase consumption. So bond yields will have an impact on FD rates. Yes, it has an impact. That is what was the question. Okay, so even repo rates have an impact. Everything will be run by repo rate. So will it have an impact on the FD rates? Yes, it will have. Why did my FD rates increase now? So repo rate is 6.5 and FD they are paying 7.5. Earlier, FD was only 6%. Now banks are paying 7.25, 7.5. That means as and when my repo rates are high, banks are ready to pay. Okay, are you able to get this? Okay, so this is something like, so everything is interlinked. If government is borrowing less, that day, the yields went down. Yields went down. Okay, so when government borrows less, when the yields are less, so government is borrowing less means, madam said I'll make FD 5.1. Means I'll not borrow much. So what does it indicate? I'm not going to issue much of GSEC, etc. And the bonds were giving less yield. Why? Because everybody was thinking of buying the existing bonds only. Okay, so price increased and yields were falling. So when government bond is giving 5.5, the corporate fellow can give 7 and raise money. Are you able to get this? If government bond is giving 5.5, corporate fellow can give loan at issue bonds at 7. Adani Green will say 7.5. And he can raise capital easily at lesser interest. So this will crowd in private investment. Whenever our FD is less, government is borrowing less. Okay, so it will crowd in private investment. If government itself borrows, government says, I will give 8% on my GSEC, and government itself is borrowing, this will crowd out private investment. This is what a crowding in effect, crowding out effect. So that is the problem of deficit financing. So whenever government borrows through instruments, and there will be a trouble for the private player, it will affect the private investments. This is something about yield, price, FD, and previous question, and inverted bond yield. Inverted bond yield means it will, you will only remember that US bonds, whenever there is inverted bond yield, there will be recession. Before US announces, we know. Seeing the graph of their bonds, you will tell. So I tell my brother who's in US, be careful with your job. There is already recession. Who told, he says? Who told? I'm telling now. So there is recession. 2008, I know, because I know when the investments went down, all the investors, I invested all investors' money only. So subprime crisis came, then it went down. Everybody will catch you. So that means a crisis is coming. There will be some indications already there. So in US, it is taken as a very strong indicator. I think it is. I don't think he will ask, but already factors affecting bond yield, they have already asked last year. So therefore, that should not be a problem. Price, yield, types of bond. Okay, so that's it. Okay, that's all. Thank you. You're reading regularly? So tomorrow, tomorrow there is India and international institutions, WTO, industry. There are 3 more classes actually here. I don't know. You said Sunday. Today is what?
We get scheduled till Sunday only.
Okay.
Even it was written for 6 days. We'll have.
Okay. Okay. Fine. Okay. Done. So those are the topic, international institutions, right? WTO and all that, IMF, World Bank and all. And other institutions also, industry also, right? That's it. Thank you.